Hello, everyone. Good evening and welcome on this fine evening today as we discuss about the fine nuances of due diligences, investment banking, M&A advisory. Now, all these words usually go on hand in hand with very top of the level practices and big names and looks like a very fancy word. But today, this entire refresher course has been structured to ensure that we talk about all of this at a very primary level so that all of our SMPs largely can well into this, think about this as an option, and also try and evaluate if they can really render services in these lines. With the IBC, with the various discount, various assets available at throwaway prices now, ready-made industries, ready-made plants, and deal making now is the heart of the season, as you will see. Very soon we've just heard about the recent deal of Future and Reliance. The future is now with Reliance, as people are saying. With all of these things happening, why can't we explore an opportunity something like this? And therefore, WIRC, the Dynamic Leadership of CLL, we've structured this entire refresher course to ensure we impart some skills of valuation, deal advisory, due diligences, M&A to all our small and medium practitioners as well. Today, before we begin, we've got our immediate past chairperson, the dynamic CA Preeti Savla madam, and I also welcome all our speakers today, CA Rakesh Ji Sony from the Tata Group, CA Raja Ji Lahiri, partner Grant Thornton, CA Santosh Chandrasekharan, again partner Grant Thornton, and I'm joined by my colleague CA Manish Gadia and our vice chairman CA Vishal Doshi. May I request all of you to please put your hands together and welcome all of us, all the speakers today on this event. And at the start, I would request our immediate past chairperson, Preeti Madam, to please share her views. And she comes from a strong background of M&A advisory. So I would request her to please guide the way forward. Over to you, Preeti Madam.
Good afternoon, friends. All the dignified faculties for the session and my colleagues in the council. Friends, today we have structured this program M&A private equity deal making in this new world of deal making. It is a new world as it is said in last 5 months. Lot of things have been changed. India is becoming Atmanirbhar Bharat, and because of that, lot of even equity funding and government is also promoting new ventures over India. Further, manufacturing sector is opening up, and in this scenario, how this M&A practice as well as deal making, how it is structured. So we have very dignified faculties with us to go through this entire M&A structuring and deal making transactions in the current scenario. I, on behalf of all the participants, welcome the faculties. Further, I would, in absent today, we have two programs simultaneously running at WIRC, and hence chairman is not able to join this program, and accordingly we are doing this program. We have the RCMs present, Vishal Bhai, Arpit Kabra and Manish Gadia over here in this program, and other program is running simultaneously. Friends, we look forward for your feedback also for any and suggestions so that we can conduct other programs according to your requirements at WIRC. Again, once again, I welcome all the faculties and looking forward to a great fruitful session. Thank you very much.
Thank you, madam. Absolutely. We are all keen and looking forward for a very value-add session over here. So happy learning, yes, to all the participants. As we immediately kick off the session, I would request Vishal Bhai to please introduce our keynote speaker today, Sri Rakesh Sony ji. Over to you, Vishal Bhai.
Thank you. Thank you, Arpit, and very good evening to all the participants. It is my privilege to introduce CA Rakesh Sony ji today. In fact, I would say he's a chartered accountant and graduated from the same college that I have done from St. Xavier's, Kolkata. Presently, he's a global head strategy and M&A at Tata Consumer Products Limited. Mr. Sony, he joined the company in 2017 and has been part of various new initiatives in the organization. He is responsible for the development and deployment of strategies and the delivery of new businesses, acquisitions, divestments, alliances to drive the sustainable, profitable growth agenda of the company. He is also responsible for the investor relations of the company. Mr. Sony has over 22 years of experience and has held key leadership roles in the private equity and investment banking world. He was the director and India head of Protera Investment Partners and partner at Motilal Oswal PE Fund. Before that, he has successfully co-founded an investment bank. He has led multiple M&A deals and successful investments in the food and consumer space in India and has assisted companies in their strategic transformation process. With this, on behalf of WRC, I welcome CA Rakesh Sony, and back to you, Arpit.
Thank you, Vishal bhai. Indeed, so it's a pleasure to have you with us today. A tall personality, not only by theory, but having really worked at the grassroots level, having executed so many deals, M&A, and the subject topic that we are talking about, a perfect expert on this topic today. So thank you for joining us, and believe me, friends, it was at a very short notice that we had invited Rakesh ji, and we are so glad that he said that if it is for institute, I'm ready to spare some time. Although we would have some time difference, we would have some difficulty in getting clearances from the boards, but he readily agreed to be part with us on because it's a CA fraternity event. So thank you, Rakesh ji, for sparing your time with us and being with us today. I'll request, before we can start off, I'll request Manish Gadia sir also to introduce the other two faculties as well. We've got a super personality and a consulting from background, Rajaji and Santosh. So I'll request Manish bhai to please introduce them so that we can have an uninterrupted session for the next 2.5 hours. Manish ji, over to you.
Thank you, Arpit, for giving this opportunity. First I will start with CA Raja Lahiri. He is a very experienced person. He is currently partner with Grant Thornton and is managing partner of Consumer, Healthcare, Technology and Financial Services Business Group for the West region. He is also part of National Minder Group Cultural Leadership Team for firm and member of a Global Technology and Private Equity Steering Committee of Grant Thornton Global. Raja is qualified chartered accountant from India with 25 years of experience in accounting and consulting world in India, and has also led global cross-border client engagements in US and Europe also. His consulting experience cover auditing, due diligence, deal advisory, private equity fund advisory, forensic accounting, management consulting, and corporate governance matter. He had led and advised for more than 300 plus deals and has advised private equity venture capital fund, corporates, India as well as international, and has led some of the marketplace transaction for leading corporates and PE fund. He has led some of the market cross sector and deal for Tata Group, M&A, Mahindra and Mahindra, Infosys, Wipro, JSW, Blackstone, and list is very long. Raja has spent close to 14 years in one of the largest accounting and advisory firm, KPMG, and was one of the co-founder and large accounting firm transaction advisory practice, and also been part of the core team of financial investigation of India's biggest corporate frauds. So with these few words, I request all of you to welcome CA Raja with loud applause.
Thank you.
Now we have with us CA Santosh Chandrasekharan. He is currently director with Grant Thornton and leading the firm Merger and Acquisition Advisory Services in Southern India region. He is based out of Bangalore. He focuses on the healthcare, pharma, medtech, and IT and technology sector. He is qualified chartered accountant from India with 15 years of experience of corporate finance. His consulting experience cover auditing, due diligence, deal advisory, private equity fund advisory, and management consulting. He has led the advice and more than 50 deals and advised private equity, venture capital fund, corporates, India as well as international both, and led some of the Mercury transaction for leading corporate and P fund. Santosh spent close to 6 years in one of the largest accounting and advisory firm, PwC, and he worked in organizations as PepsiCo, Sterling Group, and Cartel. So with these few words, I request all of you to welcome CA Santosh ji. Now I also introduce CA Alok Verma, who is also going to join with us in some time. So Alok is a senior strategy leader with over 20 years of experience in consulting across growth strategy, commercial diligence, corporate strategy, merger and acquisition, market entry, strategy, innovation, and performance improvement advisory. He has led several commercial diligence engagement across auto, IT, pharma and healthcare, retail, etc. Alok worked actively with industry forum like CII, IDG, IACC, SOCHM, FICCI, ET, ACMA, and other trade forum. Prior to joining Grant Thornton, Alok was automotive sector leader as leading strategy firm. Some of Alok's recent publication which captures his perspective and innovative and disruption across industry segments. Indian auto industry to innovation, NPD and globalization. The list is very long, and Alok is mechanical engineer and IIT Delhi and an MBA from IIM Bangalore. With these few words, I request all of you to welcome Alok ji also. So thank you very much. Over to you, Arpit.
Thank you, Manish bhai. Thank you for introducing all the three faculties. Alok ji would be joining recently. He's just got a call, so therefore he is just taken off time. And in the meantime, I'll also request, and I want to update everyone that today's session, Raja ji has helped us a lot to structure the entire program today. And thank you, Raja ji, for your inputs there. And I request you to please kick off the session with your insights on this entire space, largely on due diligence. For SMPs, keeping them in background. Over to you, Rajaji.
Sure. Thank you, Arpit. Am I audible fully? Okay, great. Just before I start, I just want to upload the presentation. So is that?
Mishraji, please share screen with Rajaji.
Yes, sir.
Okay. Can you see the presentation?
Yes, Rajaji. It's good. We can see that.
Okay, great. So I guess first of all, thank you very much, Arpit, for kind of curating this. I must say that it's absolutely an honor and privilege to be part of this. Thank you, everybody from the Western Institute Regional Council, and of course speaking to so many fellow chartered accountants. So I guess I hope in the next 2.5 hours to 45 minutes, we will make this as I would say conversational as possible. I guess there is an opportunity to interact through the chat box and questions. We do have a fairly, I think, a solid panel of speakers today, and I think without much ado, I would straight away get to the topic in hand, which is really about deal making. Just a little bit about myself. As you can see, for consultants, the introduction is so long, but true corporates, the deal makers, it is pretty crisp. So I guess we'll possibly, I'll update that, keeping in mind for the future. But I think nevertheless, you know, I think before I start, I would say that for me, fundamentally, you know, deal making, when we talk about this today, while I introduce certain aspects, but more than introducing certain concepts or tools or perspectives, what I would like to possibly share is some stories, some real life stories, where I've experienced, some of my colleagues have experienced, and hopefully that will resonate with all of you. And I think for me, deal making, as we talk about it, is really about various facets, right? So somebody said that, what are the perspectives of a deal, right? Is it only mergers and acquisition? Is it only a fundraising? Is it only an IPO listing? But I have a very simple analogy to that, which is every moment, every day, every one of us is actually doing a transaction, right? Either you're buying something, selling something, or fundamentally transacting. So deal making is nothing but, in some capacity, subset of that transactions, right? So either you're buying a company or selling a company, trying to raise funds from another investor. So fundamentally, every one of us in everyday life is actually doing a deal. Well, before I jump to the deal, I guess I just want to make sure that that these views are completely my personal views. These are not attributed to the firm, and as like any consultants, there are caveats. Uh, well, before I get into the deal making landscape, I think just so that all of you are fully aware of it, how we will planning to structure this is fundamentally give you some sense of, in my view, what the deal making landscape is, and then get into some perspectives from a corporate, and then we'll discuss something around the process. So that's a fundamental flow of the session. So I guess very different environment, right? Today, uh, it's of course a pandemic. It's completely changing the way we are operating, and the way we are speaking today is can somebody say it could be a constraint, but it's clearly a great opportunity, because in some capacity we are connected with 400 odd people at the moment. And from a Grant Thornton perspective, a study was done very recently. It's called the Global Business Pulse study. The Global Business Pulse is nothing but trying to get a sentiment in terms of where businesses are heading, right, globally. This was done in partnership with Oxford, where as a firm we interviewed 10,000 mid-market business leaders, typically business owners and CEOs, across 29 countries globally. This study has been done annually by the firm over the last 15 years. And as you can see, the study basically captures really two broad buckets. One is the business outlook, in terms of what are the business conditions, what is the business optimism, what is the outlook on investments. That's the outlook, because end of the day, businesses are built keeping the future in mind, of course, fundamentally on the current situation as well. And the second perspective is around restrictions, right? The restrictions to businesses, basically demand, right? Do I have enough demand to prop up my revenue? The supply, right? Whether it is raw materials, labor, uh, logistics, and all of that. What about the supply? So demand constraints, the supply constraints, and finally uncertainty, right? You know, is what's the real constraints on certainty of businesses? And that's how the index is developed. So it's basically a numeric index, and a score of 100 is the best, right? So your businesses are best in terms of outlook, which is the future, and also best in terms of the least amount of restrictions, right? That's the index. The study revealed, and this study was done uh, as of June 2020. So nobody's guessed really what the study revealed. The study basically revealed that this is the first time that the index has turned negative. Uh, of course, is a huge blow because of the pandemic and the virus, and the global index is actually -10, right? So nothing, no new news. It's absolutely in line with what the impact on the economy is. So it's -10 globally. The outlook is also negative, clearly large drop in the economic optimism. And of course, restrictions are very significant, right? That's also negative because you're really supply side is also constrained as supply chain has got disrupted, uh, as demand has got disrupted. Certain economies, certain businesses may not see the light of the day. So there's a huge shortfall in sales and revenue and demand. So that's obviously pretty much negative. If you look at the business conditions again have fallen, significant impact on the business conditions. But what is interesting, I think two factors here. One is this is about the mid-market, right? This is mid-market businesses. Mid-market are small to mid-sized companies, which is really the vibrancy of the economy. The interesting part is 34% of mid-market companies, firms across the world are actually expecting an increase in revenue in the next 12 months. So there is some positive, right? Of course, depending upon regions and sectors. So everything is not gloomy and dull. So there is clearly some companies are doing certain things to increase revenues. In terms of uncertainties, 2/3 of business leaders believe that uncertainty is a reality today. So what will happen tomorrow? What will happen to my supply? What will happen to demands? What will happen to consumers? Is absolutely uncertain. So people talk about the VUCA world and all of that. So uncertainty is part of our life. But very interestingly, from an optimism perspective, 43% of companies believed that they would be optimistic for the country's economy in the next 12 months. Now, what it means that while we are going through a very significant churn in businesses and economies and all of it, but the results are better than what one expected. And I can be honestly from giving my perspective, when it hit, let's say in March, April, one really had a thought that what happened to our business, what happened to clients' business. But interestingly, what one is seeing is, I call the word resilience. That means businesses, people are resilient to make sure businesses run, continue, and looking at growth. So everything is not down. And as you saw from our report, clearly 40% plus are optimistic of the economy. So there is something going on as we go through these conditions. In terms of the supply, I guess the biggest constraint, of course, labor is an issue, supply chain is an issue, but the biggest constraint one is seeing from our study is access to capital, right? We have a huge issue of banks clearly not giving capital, private equity, venture capital funds, very, very cautious. So there is a huge amount of constraint of access to capital and finance. And as we all know, as I guess as chartered accountants, I would say as any businesses, finance is the lifeblood of any business. So that is a big constraint today, and that's a reality. But what is interesting is while we have a lot of constraints, the investments in technology, investments in R&D are actually increasing, right? So as companies are going through this process, so there are companies which are investing more in technology, digital tools, because today technology is not an enabler. I call it technology is business. In fact, an interesting thing that we debated within the firm that possibly consulting firms 10 years would be largely technology firms which will be doing consulting services and not consulting firms doing technology services. So there is a significant shift happening there as well. From the demand side of things, 55% identifies shortage of orders. There's a huge demand constraint, and which means that sales are going to be very challenged, which also means that companies would need to look into other avenues of revenue. which means business models need to change, which means that today, if you're looking after, let's say, one part of the business, tomorrow you need to possibly focus on some other aspects of the market where revenue growth will come from. So as you can see, there is clearly some driver, but some changes that are significantly required. I think the one thing that came out very clearly from the report, that US and Europe significantly impacted, but in terms of business optimism, Asia Pacific remains to be number one. And I think, as a speaker started in the first, that India itself, in my personal view, is extremely well positioned today. And a lot of our energy, and I call it, end of the day, when you're doing a transaction or a business, end of the day, it comes down to one's energy, right? So India's positioning today, in my view, is fantastic. At a $2,000 kind of per capita, there is far more to go in terms of growth. So which means deal making becomes very pertinent for any Indian, whether you're a corporate, you're a deal advisor, or in any business. And I call it the deal journey, right? And I call it the deal journey and not a destination. So deal making is not point A to point B, but it's a journey. Well, where do we stand really in the deal making journey today? And this is now coming specific to India. Well, we've heard about the term new normal, etc. I think I would really call it the current environment. I think one, cash. You've heard that repeated, I'm sure, multiple times, but this is one fundamental thesis that I've always followed. Is end of the day, the cash is really the true indicator of business, and cash is king, and will always remain king for the future. Right, a lot of new terminologies are coming out in cash runway in terms of how much of time businesses can really have to survive. So cash is very critical. Secondly, the 6 sectors impacted, everybody knows about that: aviations, hospitality, food, beverage, consumer, retail. Significant impact, right? People are not going out of their homes, they're buying online. But as you can see, that certain companies in the online space, they have seen 200% growth in the last 3 to 4 months. And as we are working as a firm and as an individual, as a professional with some of these tech companies, they have seen massive growth in the last 3 to 4 months. So the businesses are also changing quite dramatically. Valuations, clearly valuations, nobody's guesses, have impacted significantly across all sectors. But certain sectors like digital, technology, pharma, life sciences, education, edutech are actually seeing upside in valuations, because that's the future, the way businesses are going. And why I'm saying this is because these are the trends that will really capture in the way the deal making process will move and the deal making environment will move. As of today, the M&A scenario is, as expected, pretty muted. Significant deals are on hold, they're aborted. But let me be honest with you that we've obviously seen one of the largest deals globally that came from India, Reliance Jio, right? In my view, that one deal has established the power of India's digital powerhouse in the global scape. All private equity investors globally, Facebook, Google, have invested. So I think that's a very, very significant positioning for the deal-making environment in India. So that's a very big positive. The second, I would say, is from my personal perspective, we actually closed 4 transactions, fairly decent sized transactions, the last 4 months. And which means that it's not that deals are not happening. Deals are happening virtually, virtual data rooms, virtual deal rooms, virtual negotiations. People are closing transactions. So it is not that no deals are happening. From a private equity perspective, today private equity's focus is largely on portfolio companies to sustain, survive. So private equity investments are on hold at the moment generally. However, we've actually seen some large buyout transactions that have happened, right? Some of the large funds have invested in pharma companies, edutech companies. Byju's bought a large company. So there is significant activity. But as I said, is the activities are happening in sectors which are future ready, right? So tech, healthcare, online learning, telemedicine emerging as robust investing opportunities. And lastly, I would say the ESG theme, the environment, sustainability, governance, right? Sustainability, is your businesses sustainable for the environment? I think those themes are going to play a pretty important role. Stressed assets, and I think Arpit talked about it, stressed assets are going to increase in sectors of commodities, steel, mining, etc., which also means that the distressed funds will get very active. IBC is obviously on hold, but one is seeing fair amount of action to do M&A in those sectors. So clearly that's a space to watch out for. I talked about the Reliance transaction, the Geo transaction, and I think another change is in the FDI policy. As all of us are aware of that in certain countries the FDI is restricted. What it means that the deals that were proposed to have come or investments from that regions, including China, would now need to pause, which means that companies who had investments may need to see alternative sources of financing as it moves in the next few quarters. Some deal fundamentals, well, I call it my Bible, right? These are some things I picked up during my journey in the last 2 decades on deal making. I think first is an individual that I've always admired, Warren Buffett. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you will do things differently. I think the reason I say this, that whether you're doing a transaction or a deal, right, end of the day, if you're a buyer or a seller or an investor and investing money in a company, right, fundamentally, it's not just capital that is involved, but your reputation is also involved. So I think very key to remain that when we are doing any transaction, reputation first. I think the second, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I think a lot of us talk a lot about pricing. What is the valuation of the company? What's the pricing of the company? But I'm not sure that whether we truly differentiate between price and value. Value of a company is not just valuation, right? Valuation includes value of management, value of the CEO, values and principles of the business, quality of customers, various other things. So it's important, the subtle difference between pricing and value is important. Warren Buffett's statement, and by the way, he celebrated 90 years, but something that I've always admired, the way he looks at things. Price is what you pay, but value is what you get. So when you do a M&A, when you do an acquisition, it's one price, $100, $100 million, $10 million, but the value what you get is different. You can invest 100, but you can get 10. There are lots of deals that have not happened or failed. So keeping that distinction is different, keeping that lens. Sometimes the best investments are the ones that you don't make. In a deal making scenario, the adrenaline rush is very high, right? It's great to announce a deal, but sometimes the best investments are the ones that you don't make. So it's important to understand where to stop. And I think taking this example, I remember the example of one transaction. This was the Infosys transaction. Infosys, there was a company called Axon in Europe, where Infosys was bidding for the asset. And then after that, at a certain price, it was a very large transaction, bid it for the asset. Pretty much the deal was done. And suddenly there was another buyer that came in. That happened to be HCL. And HCL actually bid high than Infosys. And then a lot of bidding war happened. And then finally, Infosys said that I will not bid above a certain price. Well, what I'm trying to say is, end of the day, one should know when to stop. It's great to announce a deal. And by the way, in this scenario, Infosys spent 2.5 years on this deal, but they finally said, this is the last price that we can pay for, because they were clear about the value they can get. So sometimes the best investments are not the ones that you don't make. Be dispassionate about M&A. So it's very easy to get carried away by this great deal story and all of it, but it's important to understand, is it the right strategy for my business? And sometimes I've seen that a very simple question, why am I doing this investment? Why am I doing this deal? What is the value am I getting? These three critical questions, very simple questions, but very difficult to answer. A lot of corporates, investors find it very difficult to answer the question. Couple of things which are, I think, changing. One is due diligence. I think due diligence will get very extensive, because not just because of the process, because today money is scarce, right? So you will think twice before putting in your investments and your money. So diligence will take different shape, far more intense, and will look things around backgrounds of promoters, backgrounds of companies, forensics, but fundamentally to get a comfort on, are you really buying the right asset, what you thought through as a strategy. I think the second is the deal valuations. I think valuations have been significantly based on comparable multiples, the stock market, and all of those kind of things. But I think now it will come down to basics, cash flows. If you're not generating cash, in my personal view, it will be very difficult to get valuations. So it will come to the DCF method of valuations, discounted cash flow. Are you going to get cash from your business? I think key man insurance, succession planning. Now let's not kid ourselves, right? It's a health pandemic, right? When you're dependent on business owners, when you're dependent on certain individuals, right? We need to think about what if something goes wrong to that individual. So in deal making as well, that to keep backup plans of succession planning and key man or key person insurance, I think will become important. And finally, deal structuring, right? Today's time, there would be multiple innovations of structures that I would see that will come on the table. It could be stock versus cash. It could be earnouts. It could be various structures. And I think innovative structures would have to come in play as companies merge, as acquisitions happen. What are entrepreneurs thinking? If you look at an entrepreneur today, I think it's not easy for an entrepreneur. And having talked to certain entrepreneurs, I think one of the big question is, am I going to survive during this crisis? Do I have cash? And I think some of these questions, I think key is call for action. Are you quickly readying yourself for a fundraise? Are you quickly getting an advisor on board to make sure that you're advised to talk to funds? Or are you really taking an action to make sure that you're ready for a M&A transaction? Or are you ready to liquidate? Hello, can you hear me now?
Yeah.
Rajesh, we just lost you in between
Hello?
actually. Hello,
Yeah, we
Rajesh.
can hear you now, Raja.
Okay, yes, sorry.
Yeah, but
You
we
can
can't
hear me
see
now?
you
Okay,
anymore.
okay. Yes. Oh, okay. Just give me a second. Can you see me now, or can you see me now?
No, we
No,
can't.
not really. We can hear you, and your slideshow is now. So maybe you can just start your slideshow again. So there's the
Okay,
camera
just
button.
one
If you can
second.
just switch it on.
Just 1 second, please. Yeah, apologies. This is thanks to the. Yeah, can you see the slides or not? Not yet.
So we can see your slides right now. Just put it in slideshow for mode.
Okay. Can you see my
That's okay.
slides?
Yes, yes. So
Okay.
please go ahead. Once you get
I think
data
I'm
back,
having.
you can go on the screen again.
Yeah. Exactly. Yeah. Exactly. So I'm going ahead. So coming back to the entrepreneurs, I talked about entrepreneurs. In terms of the channels for fundraising, right? You could, as everybody knows, that really from a private equity to debt to mezzanine to potential sellout, and of course, initial public offer, right? And during these times also, we have seen that there are companies that are planning for IPO. So it's not that people are not readying themselves. But I think my personal input here is one is leadership. One needs to lead, and the important is to call for action, right? So plan well, but you got to decide. So don't wait for things to happen. And finally, uh, looking at investors and buyers. I guess buyers are waiting, in my view. And there are corporates, there are buyers, and of course Rakesh will I'm surely will touch upon that. There is no dearth of capital. There is significant capital lying with corporates. There is significant capital lying with private equity funds, with banks. But what are they waiting for? They're waiting for the right sectors. They're clearly looking at valuations, but fundamentally, the assessment of the risk that I talked about, the return on investment, is getting much more intense. So due diligence, financial models, the business, the market, the industry, all of that, the lens is much more higher today than ever before. And in my view, that is a good thing, not a bad thing, because fundamentally good businesses will sustain and will grow better, whereas not so great businesses will need to possibly consolidate or may need to potentially, unfortunately, liquidate in these times. Yeah, okay. I hope you can hear me, right?
Yeah, we can hear you.
Okay. So quickly rounding it up, in terms of the deal landscape in India, before I move to Rakesh, is quickly some statistics so that you get a flavor of the deal value landscape in India. This is something that we come across from the firm called the Grant Thornton Deal Tracker Report. We started publishing this report from 2003. It's close to 16-17 years. And as you would see from the deal value, right, India has been clocking from $40 billion plus from 2014. So it's a pretty large market. And as you can see in 2020, in Jan to July, there is $49 billion of deals, right? Which is, of course, significant number. And as you can see, it is M&A is 27 billion, private equity is $21 billion, and number of transactions are, if you look at it, it's close to 2,000 odd transactions across sectors. So it's a very vibrant market, and in my personal view, that while 2020 we will see a blip in terms of number of transactions, I think 2021 and 2022, I think India's deal making market will be quite vibrant as we go through this geopolitical shift globally as well. If you look at the private equity deal activity, it's again been very, very solid. Clearly 2020 has been largely driven by the Geo deal. If you look at the top private equity deals in India in 19 and 20, one would see that deals across sectors, right? From telecom to manufacturing to e-commerce. And I guess this trend will possibly continue. So clearly technology, e-commerce, certain infrastructure management, like, we obviously saw a large deal happening in the airport space recently. I think those sectors will continue to see lots of deals. From an M&A perspective, clearly one of the largest deals for the ArcelorMittal SR Steel, which is a great deal for the IBC case, right? We had a pretty much 100% recovery of the banks. So those are solid deals to really make sure that the IBC is successful. And finally, if you look at the M&A sector, right, we also saw deals in the financial services sector. And I think that's some sector to watch out for, because as banks will go through their changes of NPAs and other issues, we will possibly see lots of consolidation in that sector as well. So I guess with that, I call it the new deal world is clearly emerging in front of us. And fundamentally what it means that for India is, as I said, the price and value is different, right? It's not the same. And the second is that while we are going through this change of economy of the pandemic, there are clearly different business models that are emerging, and that will see potentially lots of deal activity. So I'll stop here and then get into a discussion with Rakesh. So maybe Arpit, I'll request if the screen can be pulled off, then I can request Rakesh to come in.
Just do that.
Great. Great. So Rakesh, first of all, great to see you, and you know, thank you for coming in. I think I've talked about from my experience, but I think you have seen it all, in my view. You've been an investment banker. You've been in the private equity world. You've now the global M&A head of one of the largest corporate in the globe, Tata Consumer. Uh, and I think it'll be great to first get your views, right? How do you see the current deal making environment, right? We talked about the pandemic, but tell us a little bit about the current environment, and what sectors do you see this reshape happening as we move in these times?
So, first of all, thanks the institute and everybody from the Western Council and Raja to have invited me for this conversation. Good question, honestly. In the last 6 months, ever since we have got into the pandemic situation, the first 2 3 months was honestly was the period of survival, because nobody knew what does this pandemic mean, whether we will survive, not survive. So when this pandemic hit us, and we all sort of got huddled into a conversation, and we said, we need to revise our budgets, we need to make our plan. And when we made our revised budget for the year of 2021, in Q1, we expected that our revenues will be 30% of our projected revenues. And so that was the quantum of pessimism which was there in the system. 30% of the revenue. So we thought that our demand will be impacted by almost 70 odd percentage. As the case may be, we end the quarter with a growth of 13%. So against a perception of
Amazing.
minus 70, we delivered plus 13, which means that the impact on the consumption has not been as bad as we had expected it to be. Especially when you are in the essential items as we are. Uh, if you look at globally, and we do have global businesses, we do have businesses in UK, US, and Canada. In fact, the growth in those markets have been even more than what we have witnessed in India, and it's largely because of pantry loading and increase in in-home consumption. What we also sort of misread or miscalculated was the savings that has happened because of discretionary spends not being there. So your advertising, your sales and distribution, your transportation, your travel, your promotional and activity, your BTLs of the world, significant dip and new ways of working. So I guess this pandemic has taught us a lot. I mean, today we are doing such a large conference over a call. I don't think this was something that even the institute had ever thought in the past. So I think all in all, what is coming out is, in my view, positive. Yes, there are sectors that will get impacted. There is no doubt about it. But then people will find ways and means to sort of live for the another day, as we call it. Now coming to the deal scenario, as I mentioned to you, that first couple of months, there was no thought of deal, but it was all about surviving. Having done that, what we've also realized is that there will be a huge wave of consolidation that's going to happen, and we are already seeing that happening in India. I mean, there was a large deal that happened 2 days back, and I don't want to speak about that deal in particular. But if you look at businesses, there are two things that are coming out very clearly. Is that one, the business models are getting challenged. So if you have a business model which is dependent on a very long working capital cycle, and where you have working capital which could run between 80 to 90 days, you have a problem. Because the people from whom you are supposed to get money probably won't come, and you will have to keep on paying your creditors on time. So the most important thing was that how do you preserve cash? And businesses that inherently don't generate cash or does not have the propensity to generate cash will face the headwinds. And that's exactly what happened in future, if you all see. Because they were in a business where they had to pay all the expenses, salaries, rentals. However, the cycle got jammed, and even a 15 to 1 month jam actually created a havoc. So all the retail businesses for that matter, I mean, we do run Starbucks in India. We also face a similar situation there. However, our situation is very strong because we do have the wherewithal to manage the cash losses that we have today. So very clear is that businesses that are basically at the fence or at the cliff, will have to take a call. So either they sort of partner or sort of align with a larger group, or they will probably not exist in the next few quarters or months, as we say. So you will see a lot of consolidation. The other thing that has happened during this particular situation is that the asset valuation have been repriced. So there are certain businesses which are very solid and they have been completely valued differently. I mean, look at in our case, for example, when the pandemic hit, our market cap was 35,000 crore. We went down to 25,000 market cap, and today we are
Sure.
53,000 crore market cap. Now, what does that mean? It
Amazing.
does not mean that my business has fundamentally changed. What has happened is my value of my underlying business has changed because it has seemed to be far more robust than what it was before the pandemic. So any business that is coming out strongly to say, okay, my brand is strong, my ability to deliver my business irrespective of these challenges is very strong, and I am able to maintain my quality of service even though I have all the challenges in the world. So this is where the corporates and the brands have been differentiating. It's a time when you are differentiating between the boys and the men, and clearly the men are being valued very, very differently. So so that is what has happened and what has changed. I do feel that there will be significant M&A activity that you will see. You will start to see from Q2, Q3, 4 onward, because people who or businesses that are small in size or they are restricted. See, earlier what was happening is that, okay, I am a business and I have a very strong distribution in my region, and hence I should exist. Today that myth has been disrupted, because suddenly geography has become history, correct? There is no geography left. I mean, it's all virtual. So because of the virtual change that has happened, the dynamics of the business has changed completely. And I'm not going back to my normal self. So earlier, if my distribution cost was,
Sure.
let's say, 5 to 6%, and today my distribution cost has come down to 2 to 3 because of the disruption, I'm not going back to that 5-6% regime that I used to have prior to the pandemic hit. And hence, the businesses are now become far more efficient, and you will see a lot of flap coming out of the system. I used to give, let's say, a 20% margin to my retailer earlier. I don't think I need to give it anymore going forward, because I know my brand is so strong that people are willing to buy me even if I give a lower margin. And if my distributor does not sell it, somebody else will sell it. So there are very interesting, innovative options that has emerged across the businesses. Whether it is technology, whether it is direct to consumer, whether it is direct to delivery, and hence I feel that you will see a lot more activity in the M&A space in the next few quarters.
Right. Yeah. Rakesh, I can't see you clearly. Can you hear me clearly?
I can hear you. I can hear you well, Raja. I think your
Okay.
picture has
Okay.
got frozen. Yeah.
Okay. Yeah. So I've got a little band, but you can hear me clearly, right?
I can hear you clearly. Yes.
Okay. Great. No, I think thanks, Rakesh. I think you obviously covered a lot in terms of you talked about obviously geography is history. You also talked about valuation is repriced. Valuations are getting repriced, and you talked about how important it is about brands, right? To come in, and the confidence that investors have on delivery. So there is a huge underlying business driver that are coming in valuations. You also talked about uh, business models getting challenged. And you of course talked about cash, right? Cash preservation. And I love your point about that people who are sitting on the fence today will struggle. So coming down to the basics, and I guess possibly good companies, solid companies would continue to be not only survive, but they will thrive and do transactions. And I think a very interesting story you said that initially there was a lot of uncertainty, but you actually grew by 13%. And great to
Mm.
hear that you actually grew by 13%. And but finally you said that deal making expected to really grow in Q3, Q4, because so these are all readying for a pretty substantive deal making environment. I think that's great on that. But I think now I'll get to a different aspect, Rakesh, you've been a deal maker, right? I don't know, 20, 25 years now. You've seen various companies, various advisors. Now, it'll be great to hear from you. What are the 2, 3 lessons, if I may say, that in your experience, top 2, 3 things, top lessons or traits that you think a deal maker should have? And I'm sure in this conference we have people who want to be deal makers, who are deal makers, but it'll be great to hear from you. What are the top 2, 3 qualities, if I may say?
Yeah, I think that's a brilliant question, and the qualities, I would say, keeps on changing from time to time. But if I have to speak from today, I think the first and foremost thing is that any business that you acquire or wish to acquire, one fundamental question that should come to in your mind is that, buy versus build. That's one classical boardroom debate that always happens. See, you have to buy businesses for three things, right? You buy businesses for the brand, you buy businesses uh, for the distribution, and then you buy businesses for the cash flow that it generates. End of the day, as you rightly mentioned, it is DCF, which is nirvana, and that's the holy grail that we all have to follow. End of the day, any business that you acquire needs to make cash sense, because if that does not happen, then it's basically, you cannot see. A lot of companies in India in the past have done that and have tried to use an acquisition as a stock market tool. That does not happen, number one, and that's why most of the acquisitions have not worked, because they're not thought through. The clear thing, see, and I'll give you an example. In our case, for example, we just concluded one of the largest merger in the Indian. We acquired the consumer product business from Tata Chemicals, though it's part of the same group. But they are
Yes,
two different listed companies. End of the day, they have separate shareholders. And as you know, as a Tata group, we are very, very transparent, and everything is at arm's length.
sure.
So there was a very unique case, and let me explain this to you. And one would argue that, oh, both these companies are 40, 50-year-old. Why didn't this happen all this while? It was so obvious that why didn't it happen all this while? Today Tata Salt, if you look at the brand, it is the largest, but obviously it is the largest salt brand. That's goes without saying. But it is the brand which sells 1 billion packets a year. There is no other brand in the country which sells 1 billion packets a year. That is the kind of power that the brand has, and everything that you produce gets sold. So everything, you actually have to deposit cash in the bank, and then you get a delivery order. So that is the kind of demand that this product has. However, it was largely a brand that is wholesale driven. Now when you look at TGBL or TCPL, we were largely a company which had a very strong sales and distribution and a consumer facing organization. Suddenly when we look at getting Tata Salt from an organization which was largely wholesale, it is coming to an organization which is now becoming a larger food and beverage company. So earlier we were only beverage, now we are food and beverage. When I go
Absolutely.
to a distributor today, earlier I was only selling tea. Now when I go to him, I'll sell you tea, I'll sell you salt, I'll sell you pulses, I'll sell you. So his ROI completely changes, right? Because yes, in the earlier day, if it was a retailer, he would probably have maybe 100 square feet or maybe 50 square feet space for a tea product. But today he can dedicate 200 square feet and give it to us. Say, okay, we can carry all your products. Our ability to negotiate, our ability to manage, our ability to invest behind technology, our ability to invest behind resources, all of that has gone up because my throughput is 2x of what it used to be in the past.
Surely.
Correct? So if there is an opportunity where you can unlock synergies, where you can say, okay, either it is a distribution synergy, either it's a complementary or product synergy, or it's a synergy of improving supply chain. See, you have to understand two things. In today's world, it's a fairly transparent world, right? So if somebody comes and tells me, oh, I will be able to sell my product at a higher price than my competitor, I think you are flying kites. If you are selling a Pepsi, it has to be sold at $10. It will actually get sold at $10, whatever you do under the sun. I mean, you cannot increase even 1 rupee. I mean, there are certain categories where and especially when it comes to
Sure.
consumer categories, so you cannot increase the price beyond a point. There is a upper limit there. But what you can do is reduce your cost. Now, you cannot reduce your cost by compromising on the quality of the product, because in today's age and stage, quality is a given. Correct? You
Absolutely.
cannot afford to. So how do you reduce cost? You can only reduce cost by better supply chain, by consolidating. So whenever you look at an M&A, these are the things that you need to look at. The problem is that whenever we look at an M&A, we'll look at the revenue and we say, okay, this revenue will get added, and this is a profit that will also get added to my P&L, and I will do this. That does not happen, because it's a marriage. It's like a marriage.
Yeah.
When two people gets together, they need to understand each other's behavior. They can stay under one roof, because when you're acquiring a business, you're also acquiring people, you're also acquiring systems, you're also acquiring processes, you're also acquiring the entire jing bank of the vendors. It's not just that you acquire a business, because it's a complete ecosystem that is also coming to you. Now,
Absolutely.
whether that ecosystem will gel with your ecosystem is something that you need to evaluate, and then
Yeah.
only you should decide whether it's a marriage in the heaven or it is a marriage in the hell. Most of the transaction that has happened in the past, and there are books that have been written on that, where mergers, acquisition don't work, because somewhere it's beyond numbers. It is also about how do you get the right people at the right place. So in my view, there is a significant opportunity in India. I mean, look at the GSK and HUL merger, for that matter. It is the largest FMB merger that has happened in the history of this country. I mean, a deal size was
Absolutely.
close to about 40,000 crores. But look at the way they integrated themselves. The whole story was about integration. It was not about the two revenues getting together, and because of that the profit's going to go up. It's because they know that they won't be able to increase the price. In fact, they have taken down the price. So what HUL has done, the moment they have acquired this business, the first thing they did, they reduced the price by 20%, saying that we want to make the product more affordable. Because if I have to, and why have they
Sure.
been able to do so? Because on the sales and distribution, on the supply chain, they were able to save that kind of cost. Correct.
Right.
So I think
Right.
the big part here is about thinking those, and then decide to acquire. Because honestly, being part of the Tata Group, every conceivable deal that happens in this country comes to me, and if I'm looking at 100 transactions, believe to me, I reject 90% of them just by seeing the name. I don't even look at the numbers, because I know that culturally it will not match. It does not add value to my offering to my customer. Very profitable business, sir. It's a great brand, sir. Does not work for me, because is it adding to what I'm already doing? The answer is no. And if it does not do that, then I'm not interested. So I think in any M&A, you need to be very clear that these are the things that I won't do. Everybody in the world and every consultant in the world will come and tell you what are the things that you should do, but there are very few people who will come and tell you what you should not do, and that's what you should know, is my view.
I think brilliant statement, Rakesh. I think that's, I will definitely take that, keep an eye on what you won't do, right? And I think I touched upon a little bit in my opening statement that, it's sometimes better not to do a deal, but I think you talked about several layers here. You really touched upon the importance of integration and synergy. You also definitely talked about people and culture. Uh, and I think great to see the way one of the top mergers have happened in the Tata Group in the consumer side, and you really gave how important it is to unleash the synergies. And finally, the cash, right? Again, coming back to the cash, it has to make cash sense. It can't be just a
Correct.
uh, great customer, great brand, but it has to be yielding cash end of the day. Uh, so I think that's great. Now, if I want to just take you to the next stage, right? If you were to crystal gaze, right, in the next 10 years, we are in 2020, right? 2030, let's say, right? Next 10 years for India, uh, how do you see uh, deal making changing? Let's say, for example, today we are obviously virtual data rooms has been there in vogue for long, virtual due diligences. Now we are into virtual negotiations. Somebody talked to me that will we have robots actually doing deal negotiations and stuff like that. So I don't know, means the way technology is changing. uh, so if you were to crystal gaze in the next 10 years for India, and obviously you have a great view from one of India's largest corporate conglomerates, what do you think could be the changes? One, overall environment. deal making environment, and second, in the deal making process? It'd be great to get your views there.
I think that's a good question, and Raja, I would like, I mean, I'm sorry, but I would like to say that please keep this as my last question because I have to rush for another meeting.
Sure.
Let me just share with you a few thoughts of mine, and I think this is some thought that has been acquired over the last 20 odd years of my interactions with different parts of the businesses. There is a huge there is a point called commitment and competence, and people in India confuse between commitment and competence. Commitment is hard work, because even in our case, when we were kids, our parents will tell us, work hard, work hard, work hard, how many hours have you studied? Nobody would tell us, work smartly, they will say, my son is very hardworking, my daughter is very hardworking. Nobody would say, my son is very smart and my daughter is very smart, So we have grown to only work hard, okay? And somewhere we confuse that working hard is basically working smart, okay? So lots of companies in India are there where they are run by promoters. They're promoter-run companies, and they work very hard. They work like almost 26 hours a day, but they don't have the competence, because they confuse between commitment and competence. They feel, oh, I'm committed to the business, and hence I'm competent. And then there is another concept of context and content. So people have a lot of content, we all read a lot of books, we read a lot of things, but do we have the context? We don't have the context. We only have the content. I have read so much, I've done this much, and even in chartered accountants, if you see, we always used to have this study material. Are ye padha ki nahi padha, wo kiya ki nahi kiya, but do you have a context? Why are we doing it? Why did we did OR in our CA final, if I ask you? I have no clue, to be honest. I just did it to pass my exams. There was no context. It was all content driven. So two things: content and context, and commitment and competence. So people have now started to realize the importance of competence and the importance of context, and that is where the transactions start to happen. A promoter who has built a business with his all hard work for 25, 30, 40 years, he will realize that, boss, my business now don't need commitment; it needs competence. And how can I get it? Can I acquire a competence? If he can acquire a competence, he can hire a professional. He must do it. If he can't, then he should let the business be run by somebody who has the competence. So you will see a lot of activity in the mid-sized businesses where you will see businesses buyouts will happen, and that has already started to happen. I mean, if you look at last 3 months, I would say, a chemical company, a pharma company, JB Chemicals, there was another chemical company. One was acquired by KKR, the other one was acquired by Carlyle, there was another one that was acquired by Advent. Why is that happening? If you see, that is all about commitment and competence. People have run the business for 30, 35 years, but they can't run it. So you will see lots of businesses where there are succession issues, where there are competence issues, where so that is something will happen. And then when I spoke about context, you have to see that where do you see yourself 5 years from now? You need to understand the context of your being. Will you be relevant? And you need to plan things so that your relevance still continues to be there. If I'm running let's say a business which is into technology, or it's like classical television, when if you go back 25 years, there was a brand called Western TV in India, and all of us used to use Western TV. There was nothing beyond Western. But today, Western, BPL, they were the brand. They don't exist today because the context was not there. They were all so obsessed with their own factories. They thought, they are the best brands and they will continue to be there forever. Today, they don't exist, right? So I think these are the 2 points you need to keep in mind, and that's what's going to happen in the next 10 years. And yes, you will see a lot of consolidation because there is so much of capital. See, today, if you look at world, I mean, today, why are the markets firing in India? If you ask me reason, I don't see any reason why the market should behave the way they are behaving when my GDP is down by 24% in Q1, right? It is all about liquidity. There is so much of liquidity in the world. Where will it go? It won't go to China today because of various issues. China has massive issues with various countries in the world. The only country which has sort of a demand and which can consume that kind of capital is India. So even if you do our things right, I mean, we don't have to be honestly, we don't have to be extraordinary to be able to attract that capital. Even if you are okay, we just grow by between, let's say, 5 to 7% or 8% GDP and do things in a normal way, I think we should be home. So there will be 2-3 things that will happen. People who are competent, people who understand the context, and people who have the right governance. Please understand, governance is a very, very important issue that all of us needs to understand, and this is very important, especially as chartered accountants. We are somewhere, caretakers of that governance piece. Because first thing when I look at a company or anybody looks at a company, they ask, so who's your auditor? Why do they ask that question? They are not interested whether they do your audit properly or not. They want to understand whether there is a governance or not. The moment you talk about a good auditor, oh, acha, theek hai, number seek ho gaya. So that is also very important to understand. And we, as the caretaker of that particular piece, have to be very sure that we are doing our job right. So whenever you meet a client, whenever you advise a client, you need to explain in these 3 parts. That boss, you need to be competent, you need to be relevant, and your governance has to be high. Then you will probably see the light at the end of the tunnel, and otherwise you have a challenge. So those are my closing comments, Raja. And
just
thank you so
one
much.
thing, Rakesh, can we just have 1 or 2 questions? I know the panel.
I can do it for another 5 minutes, maybe.
5 minutes,
because
yeah, 5 minutes.
I have another important meeting at 6:30.
Yeah, of course. Just 5 minutes. So Arpit, maybe just very quickly 1 or 2 questions for Rakesh.
So thank you, Rakeshji. Quite insightful session that so far we're having, and we've got a lot of questions. So we just want to throw some good ones to you, and essentially they are related to Tata's also. So maybe if you can see if you want to answer them.
No question. So I can't answer any questions about Tata's. I'm sorry.
Yeah.
That will be something that I won't be able to answer. But yes, anything generic you want to ask me, I'm more than happy to share.
Yeah, so do you see IPOs being a preferred choice over PE for next few years due to increase in savings? Are you single as asked this question?
No, so let me answer this question. It is very simple. See, today the public markets in India are very mature. So you need to see what is the value that you would get. So if your company is, after the IPO, is valued anything beyond 4,000 to 5,000 crore, yes, IPO is an option for you. Anything that less than that, you will not get even a chance to survive. So if your value of your business is less than 4,000 to 5,000 crores, you should go for a private equity. If it is more than that, please go for an IPO.
So there's also so it is, I don't know if this question would be okay. After the demerger of salt and related FMCG business into TCL, so Tata Chemicals got a very good valuation. So do you really feel why Tata Chemicals is quoting below book value now, and why the valuation is so less?
I have no answer to this question. If it is valued so low, you should go and buy the stock. Yeah, I mean, I can only say that much. Honestly, I can't react on that. I'm so sorry.
So largely on a very generic business perspective, when these cash cows get demerged, largely, why is it that somewhere you see an offbeat valuation suddenly, and
that's an opportunity, right? I mean, if you see that, that's an opportunity, I would say, because Tata Chemicals, even after the demerger of this business, is still a very profitable company, by the way. So the business that has got demerged is honestly not the only cash cow. Whatever is left there is also very, very valuable, and it is a function of, it's a listed company, and if you see there is a value, nobody is stopping you to go and buy the shares of that company, and it's a great company. It has got competence, it has got context, and it has got great governance. So it tick boxes all 3. So I don't see any reason why you should not look at it favorably. Yes, you might say, oh, it's not a consumer-facing company; it's a B2B business. I mean, that's a view, and it generates a lot of cash. Cash is king. So I think it's a great company, to be honest.
Yeah. This last one question. When we talk about M&As, we see so many big M&As happening, but that is just like a tip of the iceberg. There are so many other M&A deals that usually don't fall positively, or they fail miserably. Why do you think is this a difference?
No, I did speak about that. That why do mergers fail? Because the crux, most of the mergers, people don't know why are they doing it. Honestly, as I said, you need to look at 3-4 things very, very importantly. The ecosystem, the synergies, the culture, employee engagement, and what is it adding to your brand. See, today, the world is changing, and especially pandemic has made certain disruptive changes which probably in a normal course would have taken between 5 to 6 years. Those changes happen in 5 to 6 months. For example, direct to consumer. There are brands today in India which are only digital brands are close to 4 to 500 crores, in personal care space. Now, if you can build a brand and for 2.5 3 years, so if you can build a brand in 2.5 3 years, which could be 4 to 500 crores in size, why would you acquire something, and pay 5x or 10x of revenues? So you need to understand the reason why you're buying a business. That is very important. Most of the M&A happens, अरे सस्ता मिल रहा है ले लो, अरे ये कर लेंगे फिर इसको मार्केट में डाल देंगे तो मार्केट कैप ये हो जाएगा. Those things don't work anymore because see, earlier what used to happen, there was an information arbitrage. People would not know the entire story, and hence people will do things because I know a little more than you, and hence I will be able to make a buck and you would not. Today, all of us have the same information. Today, this entire deal of Reliance and Future has happened. Everybody has all the information. It's not that you know more or I know less. So in the perfect environment which is there, it is, I would say, almost perfect. I would not say it is completely perfect, but then the information is far more. So if you should not do any deal just because there is an information arbitrage. End of the day, it has to make incremental cash. 1 + 1 has to be 3. And if 1 + 1 is not 3, then you shouldn't do it. It's as simple as that.
Absolutely. I think made your point clearly, but I will, if I may say one last one, which is important because as a leader, Ganguly or Dhoni, Rakesh?
Oh, that's a good one. I would say Dhoni for sure. For two reasons, I would say. Why Dhoni? Because he is a wicketkeeper, and I also used to wicket keep when I used to play cricket. So that is my personal reason. And Dhoni because he's a great example of being a captain and being a team man at the same time. I mean, you would seldom find somebody who kept on performing at the top of his game even after giving up captaincy, and he never level, and he's left the cricket in nice hands. So as a leader, I think somewhere you'll have to build a business, obviously at a peak, and then you should let it be in a nice hand. See, I always take this example whenever I talk to people. Then in America is actually a true democracy. Why? Because there is no president can run for more than 2 terms, because they know that after 2 terms their efficiency will come down. So if you are a true leader, you should know that my efficiency will come down after a period of time. And he's a true leader. He realized that beyond this, my efficiency will not work, and hence he gave it to somebody who is more efficient than him.
Absolutely.
So I think as a leader, you should do that, and that's the hallmark of a leader. And if you look at Anand Mahindra, for example, Anand Mahindra has not just chosen his successor, but he's also chosen the successor of his successor. So if you look at the Mahindra group, Mr. Goenka is going to take him over him, and then there is Mr. Shah who's going to take over from Goenka. So that's the hallmark of a leader who not just have his successor but a successor of a successor. So that's what I would say. Dhoni will scale over Dada. So
thank you very much, Rakesh.
I have to go, guys.
So last one, since you're here and you're a chartered accountant also, so there are many young CAs in the group today. So what was your one good advice?
Arpit, let's do one thing. I have an important meeting, and that meeting will last for half an hour. I'll come back after 7 if that works.
Perfect.
Again, I'll come back after 7, and then I can spend another half an hour with you guys. Don't worry.
Thank you.
But let me please go back because I can't be late. I have a meeting with my boss, so I should not feel that.
Absolutely. Of course.
Thank you so much.
Thank you very, very much, Rakesh. Thank you very, very much.
Bye.
Thank you, Rakesh ji.
Thank you.
So let's continue the session, Rajaji. You have, and if whenever Alok ji joins in, I'll request him to please come on the stage as well, so that we can have a entire round of discussion on deals and investment banking. Alok ji, welcome.
Hi.
Yeah. I think before we move to that track, I just want to, there were obviously very, very important points mentioned by Rakesh. I think he talked about competence, right? Talked about competence, he talked about context, and he talked about governance, right? 3 things which he feels will change in the next decade, right? And I think that's a pretty important take for any deal maker. So as we move to the next stage of the deal making process, we will touch upon the process bit, and I've got 2 of my colleagues here Santosh Chandrasekharan. Santosh has been doing investment banking, I guess, last 10-15 years, has been an investment banker, has been a chartered accountant, but has moved to being absolutely a deal maker. And of course, I've got Alok. Alok covers strategy consulting, but I guess what we heard from Rakesh as well, he talked about cash, but he also talked about how business models will change and how important is to relevant is integration, right? Talked about people and culture and all of those aspects. So it's not just financial models and P&L and balance sheets. It's something beyond that. So Alok will cover that. So I guess on that, I'll request Santosh to come in to talk us through the deal making process. So over to you, Santosh. I hope you can load the presentation. So over to you.
Hi, I'm just loading the presentation. Can you hear me? Can you see my presentation?
I can hear you, but at least I can't see the presentation. Maybe Arpit can just help that. Arpit, can you see his presentation?
So now you can.
Are you able to see my screen now? Yes, yes, now we can. Fine. Yeah.
Okay, I still can't. Alok, I hope you can see the presentation.
Yes, yes, I can see the presentation.
Okay, yeah. Okay. I think just yeah. Okay. I hope
Yeah, I think we had a great session prior to this, and it was really helpful to get some of the insights that is shared from a person who is live on the deal and who has experienced deal making from both the sides, right from the sell side, buy side, and also as a banker for the transaction. So I would be covering the banking part, investment banking part of the transaction, and how we should be prepared when we take our clients' requirement to the market. So, as with any company, there is both a buy side and a sell side pitch. It's very important we understand the requirement of our client and how we go about it from a transaction perspective. So if you look at this particular slide, what we have tried to capture here is there are three segments to a transaction deal making. One is what we call as a startup environment. Second is when the company matures and is in the growth phase. What are the transactions that we typically look into? And then third is in what we call as an expansion or an exit phase. So let me try to draw a tangent to what we had discussed in the previous session, where it was aptly told, we talked about commitment, competence, context versus content, and governance. I would like to correlate this with three or four important aspects of transaction and deal making. In terms of commitment and competence, what is very, very important here is the leadership team or the promoters that we are showcasing from a transaction perspective. A lot of people would have this question in the mind as to why a particular company is getting a significantly higher valuation than probably any of the other businesses. So one of the things an investor sees from a transaction perspective, especially in the startup and the growth phase, is how competent is this particular team or the promoter which is leading this business. What kind of ideation, what kind of strategy, what kind of dynamism this team is bringing to the table. Now, that needs to be well understood as a banker in the initial stage itself, because that is going to be a significant trump card for us when we approach the market for either fundraising or divestment. The second part of this deal making or transaction process is content versus context. Now, what is important here is most of these people have ideas which are quite large, and they keep coming up with ideas probably every week or every month while we discuss with them. But all these needs to find a shape, and it needs to find a medium through which it can be communicated. So that's where we as a banker needs to play a significant role in shaping up these ideas and performance and operational data into a subject which is easily presentable, which is well understood, and which is likely to be read clearly by the other party. So that's when we talk about an investment memorandum or a business plan. The third part is, of course, governance. Now, as you would have experienced, or I'm sure most of you would have been part of some of the deal making process. A very important aspect of a deal making process is something called diligence or a due diligence, where as a CA firm, you would have probably performed a due diligence on a target, or you would have facilitated a due diligence on a target. Now, that's where the governance part comes. And I think one of the questions was why some of the deals that happen or doesn't happen, why most of the deals fail. If you take a statistics, probably a lot of deals do end up as a failure in the diligence phase. Now, the reason why it becomes a failure during this phase is not because probably there was no performance or there are certain things that were missed, but the preparedness or anticipating for certain aspects of the deal was probably not considered, which is an important aspect from a transaction perspective. So, due diligence, I would equate it to a governance aspect. When you take up a transaction, when you take up advising on a transaction for a client, please ensure that you prepare the client well in advance for a due diligence process. This would either mean you start off with a vendor diligence, or at least start looking at their documents, start looking at their financial numbers, and see where there could be certain challenges and be prepared for it. Primary reason is when an investor or when a buyer is investing his time and effort on a transaction, he is going to spend both money as well as resources in doing this work. And he would like to see a quality data that is being presented. So it's important from our perspective that this governance or the due diligence is done well in advance, which helps in ironing out the due diligence process. Now, coming back to the transaction or investment banking aspect. So, how we go about this process is going to be very, very critical, and what makes the deal making exercise a bit more easier. I would like to take the next 5 minutes covering these aspects. So, one is, of course, the preparedness. How prepared are we from a transaction perspective? So that would mean how much time you have spent with the promoter, with the senior leadership team in understanding their thought process, in understanding their ideas, and understanding what they would like to pitch as their idea, which would enable interest in their business. So uh, it's not something that we should look at from a deal perspective as to how many people I have approached to sell this company. Rather, uh, how I have shortlisted the right set of candidates so that when I approach these candidates, I'm sure that I'm able to complete the transaction with them. So the deal preparedness is very, very critical when we move into the transaction space. So that would include you, from your perspective, looking at their past performance, looking at the future performance. I'm going to spend my next 6 to 9 months on this transaction. I should have the commitment within me to ensure that there will be a buyer whom I can find for this particular asset or an idea. Second is when we talked about the content versus context. So it's important we spend sufficient time on the deal collateral. When I say deal collateral, it involves three aspects. One is a teaser, second is an information memorandum, third is a financial projection or a business plan. So quality time has to be spent in preparing these documents because this is the first set of documents which an investor or a buyer is going to read or understand about the company. So ensure that it is crisp and communicates the message of the promoter of the company, and it need not be a 70, 80-page document. But even if it is a 10 to 20-page document, it captures the essence of the business and what it is going to achieve in the next few years. Likewise, on the financial projections, so we have to be very, very considerate about the financial projections. The reason being, we can see most of the valuation, at least post-COVID time, the valuation will start linked to the future performance of the company. That means not only at the revenue level, but even at the EBITDA level or a PAT level. So when we kind of start preparing the company from an investor perspective, private equity funding or a VC funding or a divestment perspective, please ensure or advise your client that whatever number you are stating or putting out as part of the business plan, they have full confidence in achieving these numbers, primarily because the time of doing 100% deal might be off for a while. So we can look at a transaction where it is either 51% or 74% or a staggered payout upon achieving of a certain milestone. So we should be considerate of this. Third, the most important aspect of any transaction is who we are showcasing as part of this company, the promoter and the management team. So it's important that we spend enough time coaching them, making them understand what an investor is going to ask or what a buyer is going to ask, how he is going to present his own business to them, what he should be aware of from an investor perspective or a buyer perspective, what he should commit to, what he should not commit to, and how he is able to take the story and bank upon the story is going to be a very important task that we as a banker should perform. While doing this process, it's important we develop a certain amount of trust with the promoter and leadership team, because trust factor is very, very important that we establish right at the beginning of this engagement. Unless the promoter and the leadership team opens up to us or be frank with us and ask us the right question, it will not be possible for us to showcase this business or this idea in the right perspective to the investor. So it's important you build that bond, you build that bridge of trust between both parties, and try to invest time in this period of engagement so that even if you are not able to successfully raise capital or do a transaction, it might at some point of time bleed into a larger engagement with this promoter or the team, which is what I have seen in some of my transactions. The other important point is the urgency of doing this deal. Typically, most of the promoters or most of the companies will come to you saying that I need to raise this or I need to close this transaction within 3 months' time or 4 months' time. Kindly understand this, the health of the business as to how strong it is. Does it have enough cash, enough resources? Primarily because it's very difficult to get a deal done within a 3 to 6 months period. It's very, I would say, the probability of completing this is very minimal. Probably very few deals, maybe because if they are lucky or because of the demand factor, that some of these deals get done within 2 or 3 months' time. But typically, a deal scenario is 6 to 9 months. Ensure that the company has sufficient resources and capital to wait, to be strong during this period, to be able to perform at the optimal level during this period, because the period of 9 months or 6 months is also going to be judged from a valuation perspective and transaction perspective. So please have that in your mind as a banker when you're talking to your client, that how good are they, what is their pipeline, what is the traction, what is the average revenue run rate, what is the profitability that they are going to achieve for the coming year as well. The next point here is be realistic with respect to the valuation expectation. So I think valuation is going to be a key driver for any of the transactions, and that forms the major aspect of any deal negotiation. If you don't spend significant time and do your homework on what should be the valuation that I'm going to pitch for from a transaction perspective, it's going to be a very challenging task in convincing both the buyer and the investor and your client, who is the seller or the promoter, in arriving at a common valuation pricing. So it's important that we spend significant time and effort, even during the initial phase, to understand what is that they have in mind. Typically, a private equity fund, if they are already invested in the company, they will have a threshold in terms of a benchmark valuation or IRR expectation. So we need to be sure if this could be achieved. And second important aspect is what kind of premium we can ask for this asset. As a banker, that is what any investor or any promoter will expect from us, to see what kind of premium we can bring for this asset. So considering all these aspects, we need to be prepared with some kind of a ballpark valuation range, and ensure that when we approach the market, we have some delta and cushion during the time of negotiation, so that we don't end up underselling the asset. Rather, we are able to match the expectation of all the parties. And the other aspect here is a clear understanding of the market. So when I talk about market, it doesn't only represent the market where the company is representing, but it also talks about the market with respect to the investors or the buyer's landscape. What we can see here is your buyer is not restricted only to the Indian geography. It is a global market. We can see significant amount of inbound M&A happening, inbound investments happening the last 3, 4, 5 years. So wherever we see the capital or the valuation accretion can happen, we should be open to it. This is going to lead to my next 2 points, which is collaboration. As a banker, it's very important for us to actively collaborate with other bankers and bankers from other geographies as well. because that is going to significantly impact how we are going to position this company, how we are able to identify the right set of buyers, or that one buyer who can pay a significantly good valuation. He may not be a buyer from India, he may not be a buyer from US, but someone could be from a far Eastern European country, or from Australia, or from Japan. We don't know where these buyers will come from, but it's very important that we collaborate with other bankers or other firms, which is going to be an important aspect in adding value to our client. So that's what they see as a value in us when they kind of allow us to represent them to a buyer or to the larger market. And that is going to be also one of the hallmark of the New Deal work, which Raja was talking about. So capping all this, what I'm going to say here is, as a banker, you need to be very efficient, by the way, efficient with respect to how you perform your process. You have to be very effective in the deal making parlance. You have to be very effective in terms of what you're communicating and what your expectations are. And third most important thing is enabling the deal to happen. So probably you may not be getting the right set of buyers or right set of investors, but it's important that we are in sync with what the promoters and the investors' expectation, and try to enable a deal scenario, create a scenario where all the parties are in sync with what the expectations are and whether the expectations are getting met. Just an instance here, prior to the COVID outbreak, we were very close to completing the transaction. And right at the time of COVID, um, in fact, we have already had an SPA ready. It was supposed to be signed. Right at the time of COVID, the buyer pulled out of the transaction. Now, it is very easy for us to say that, okay, fine, the buyer has pulled out. Now, what should we restart the process from the beginning and try reaching out to other suitors as well? But that's why probably as a banker, you should always be expecting these kind of scenarios, and probably you should have a backup. So in this case, we had a backup of at least 2 or 3 other buyers, and we immediately contacted them and brought them to the table. When we did that, the buyer who initially backed out immediately came in and said that we would like to do this transaction at the same valuation at which we had quoted earlier. So urgency, the kind of quickness that you exhibit in these scenarios will go a long way for you, for you as well as the client, to ensure that your effort is not wasted and you are able to kind of add value to the client. And in all these aspects, what's going to be very, very critical here is how we protect our interests. Okay. So typically what I have seen and experienced is some of us with a good intention try to work on transactions without closing our engagement. So it's important as a banker, at least try to have some bit of exclusivity for the work that you're doing. So that it gives you also the confidence, and also your clients the confidence to work along with you, to rely on you, to bank on you, and whatever be the time, whether it's 3 months or 6 months or 9 months of the process, try to see you act as their exclusive advisors and exclusive bankers. And the most important thing is confidentiality. I'm sure deal making is not an easy business, because it involves you interacting with multiple agencies, multiple consultants, multiple advisors. It's important that you keep the confidentiality part very close to your heart, and the client will appreciate it at any given point of time, because during this stage, the valuation and the structure of the transaction, if you slip up on this, there is a very high probability that you might lose the transaction. So it's very important you keep the card closer to your chest and go about doing a transaction and keeping the client confidentiality as a paramount. I just scroll to the next. I just talk you through this slide. So essentially, what we are talking about here is three aspects: what is expected from a startup, what is expected from a growth perspective, and what is expected from an exit perspective. So at a startup level, what you're looking at here is idea, team, and proof of concept or a revenue model in place, so that which will enable you to reach out to as many investors as possible and to ensure that you hit the right investor for your client. As the company raises this capital, it's important that to note that this is not going to be their only fundraise. They would need more capital in the next couple of rounds as well. And if we start preparing for it at the initial stage itself, there is a fair amount of chance as a banker we will get involved with them in the next round, subsequent rounds as well. There are reasons why they may or may not involve us, but if you are able to prove our worth as a good banker, as a trusted advisor for the client, then even if the investor believes that probably we need to have another banker, there's a good amount of chance that the client will back us or the investor will back us. So at the growth stage, what we are talking about here is the company should have seen some amount of revenue traction, profitability traction, increase in their operation, number of employees. With this, we are moving to a stage where we are talking to a private equity fund who is going to look at not only the current performance, the future performance, and how their strategy is going to affect the business going forward. So this is going to be I would say, a slightly highly rewarding exercise, because that fundraise could be more than 5 million, it could be 10 to 20 million, and it could be a multiple rounds of funding that might happen at this stage, because the company has already crossed the stage where they have to prove to the market that they are relevant. So now, with that in mind, once the company has moved from a growth stage to the next level, because they have brought in investors, whether it's venture capital or a private equity fund, they now have to start delivering results. The results come either through exit or an IP, exit to a strategic partner or a private equity fund. Again, it's important that we stay in touch with the client and with the company. We keep them updated about the performance, and a company at this stage could yield a $50 million to $100 million valuation, and it could be a large deal as a banker. And this stage will involve you collaborating with larger advisors, larger bankers, trying to showcase your network strength, your capability to kind of do larger transactions. All these will come to test, and if you are able to prove that through your network and through your firm support, we can deliver, then the chances of you hitting a large paycheck is fairly higher in this scenario. Now, while this is happening, you might also be able to help the company in doing certain acquisitions, because for them to achieve a certain target in terms of revenue or profitability, it is very difficult to do it all by themselves. So they might be looking at certain acquisitions or certain divestments of their assets, etc. So we should be prepared for all these circumstances. And as a banker, our role doesn't end only with raising capital, because the journey of the company also doesn't end just by raising capital. It's only the starting point. From there on, how closely we are along with the client and the company is going to be very, very critical for us to kind of keep churning business from them, keep making, keep adding value to them, and also at the same time, we can also ensure that our billing is improving with the client interaction. So I have two slides. This talks about the IM, the business model, which I have fairly captured in my previous discussion. So as I said, there are three major documentations. One is the teaser. It's a 2 to 3 page document that we prepare on a no-name basis when we start approaching certain investors and targets. Then upon signing an NDA, we get into an IM as well as a financial model, which talks in greater detail about the company. And the financial model is very important to understand what is the fund requirement, what is the valuation of the business, etc. So, like in the buy side, like in the sell side, from a buy side perspective also, it's very important for you to play a significant role, because in a buy side, the canvas is pretty large, where you have the opportunity to approach multiple targets on behalf of the client. So it's very important from your perspective, your scope is well defined and your approach is well defined. And what is critical at this stage is, what is the resource available with the client to do this transaction? So they might be saying that I would like to acquire a 30 crore company or a 100 crore company, 500 crore company. As an advisor, you should be sure as whether the buyer, that is your client, has sufficient resources. If they don't have the resources, how we are going to tie up the resources? That means we need to raise capital on their behalf, or we need to see arrange alternate funding on their behalf, or it could even be in the form of share swap. For all this, your banker's hat, your CA hat as a valuation expert, all these will come into play here. And that's where, even in this stage, collaboration and network effectiveness plays a vital role in reaching out to the market to find the right target for the client. So as we do this, we'll also be interacting with lawyers and tax consultants, because it involves preparing legal documents and transaction structuring. So, I mean, I'm sure most of you are also lawyers, along with pretty effective tax consultant, or I would say creative tax consultant. So a client appreciates these value add that we bring to the table. So these are certain things which we need to play along with the role as an investment banker. So the pricing analysis is where significant part of our time is spent, because once that is thrashed out, at least 60 to 70% of our work is complete. But we need to spend quality time in creating different models, scenarios, benchmarks to arrive at this valuation. And also the structure. Should we do a 51%? Should we do a 74%? Should we tranche out the consideration? What are the methodologies that we can use to pay out, and how we can tie in the target for achieving that number? So this also involves due diligence, which my colleague will cover. So finally, negotiation support and closing. Diligence we could expect certain, I would say, negotiations on valuations, pricing, structure, or it could even lead to a stage where you might have to call out the deal. I think, Raja had mentioned about the Infosys transaction. I have also experienced in a couple of situations where after the diligence is done, the deal was called out, both in terms of the buyer not having sufficient capital to do the deal, or from a seller perspective, they had committed to a performance, but the company has not been able to show that, or they don't have the right documentation or approvals in place to kind of do the process or the operation. All these are very, very important, and having spent so much time and effort, it should not come to a stage where at the last stage of the sign, during the time of signing of the deal, we come to know about this, and it results in the deal not consummating. So it's important that we are thoroughly prepared uh, at the early stages and go about meticulously planning for all these aspects, because time is of essence here. And please keep the client informed, the promoter informed. It might very well be that the promoter is not aware of some of these consequences, and we as an investment banker and advisor should help him in these stages and should keep him posted and aware of all these aspects. And wherever possible, take the help of your I would say network, or I would say from your family or community. You might have a good lawyer, you might have a good tax consultant, or you might have a good forensic consultant. Take the help of these people and ensure that when we are kind of starting to work or taking the deal to the market, at least some of these basic aspects are clear. So this will enable us to run an efficient process, an effective process, and our billing will also be assured from that perspective. With that, I conclude my section, and I would let Raja and the team, if they have any questions, can for other.
Great. Thanks, Santosh, for bringing in the perspective of investment banker. And I think you covered a fair bit of points covering from a seller's perspective and also buyer's perspective. But I guess some of the things that you clearly touched upon was the importance of collaboration, right? As an investment banker, one needs to work with the company, the business owner, the legal lawyers, the due diligence advisors, the tax consultants, other side, the buyers, other bankers. So there has to be a collaboration mindset. So it is not just a clinical methodology or a tool, but one needs a mindset to collaborate and make the deal happen, as you said. Second, you also talked about confidentiality. I think it's a great point. How important is confidentiality on transactions, right? There are so many people involved. It's a listed company. There is regulations, but more important, what happens to the reputation of a company which is trying to sell itself, right? It could be for an investment banker, for a advisor, it is one of many transactions. But for the company, maybe it's one event in its lifetime to sell itself. So hence, I think a great point that you brought about on how important is confidentiality, and I can't overstress that point. I think you also talked about protecting the interest, right? As an investment banker, right? End of the day, your client, which is a seller or a buyer, protecting the interest is so important, right? So one has to possibly fall into the shoes of the buyer and the seller, while not only thinking and doing its actions, but as if you are the buyer and you're the seller. So clearly actions will be very different. And finally, you talked about how important it is to, from a buyer perspective, to see that you get the best value out of the deal, right? And clearly the two interests are so different, right? A seller will always try to extract the maximum value because that's the seller's interest, and a buyer would always like to get the right value for itself. So great, Santosh, for covering the investment banking part. And I guess before I invite Alok to this conversation, just we'll cover on the commercial sides, on the strategy side, what Rakesh talked about on how M&A as a strategy and what do you do in a commercial due diligence. I think a quick story is it's about culture, right? And this I remember doing a transaction with a mid-sized company, and the buyer was a Japanese company, and we were actually on the on the seller side. So we were actually doing the conversation around representing the Indian company and talking about valuations, talking about terms, talking about how we would collaborate to make it happen with the Japanese. But one funny thing, and I'm sure some of you, and if not a lot of people would have interacted, is they hardly talk, right? So we went through the conversations, did all of that, and there was 30 minutes of conversation and nobody even from the buyer side talked. And at the end of the conversation, he asked a question which was, what do you mean by M&A? And funnily enough, we were stunned that, at all points, we were talking about a merger, talking about an acquisition, and here after 30 minutes, he talks about, as a Japanese on the buyer side, talks about what do you mean by M&A? And we were obviously stunned that, that either the buyer doesn't understand what we were talking about. But what actually a lesson that I learned that day is not assuming things, because we assumed that the buyer, the Japanese, didn't understand anything that we have said, and the question was so naive question, right? That he doesn't even knows what's an M&A. But through conversations, we could understand that what the question was much deeper. That he's talking about, are you talking about a culture where we will acquire you, or are you talking about a deal that we will truly merge together? So lesson learned is the Japanese not only listen very, very carefully, but their thoughts are much deeper. So that was one lesson. So culture, very important, depends on people on the other side, how various countries, various communities, various people respond. The second was a deal with the American. And here again, I was representing an Indian company, and we kind of went through a conversation and we talked about various things. In the first meeting, within 10 minutes, he asked, what's your price? And I was representing the business owner, the Indian promoter, and the Indian promoter said, we'll come to price after dinner and after lots of conversations. But the American was very clear that let's talk about price, because let's not waste anybody's time. So again, another lesson learned was from that deal was price is so very important. So let's not waste time of everybody and talking about what the M&A strategy is going to be. Come to the point and let's get done with. The point what I'm trying to make is how culture is so important, right? In deal making, it's not just only about countries, Americans, Indians, and somebody said Indian owners talk about price at the last. So it's very different based on various people. But I think the point is, as we will deal with various individuals, personalities, companies, corporate sectors, countries, I think that's a very important nuance to keep in mind while doing deals, whether you're on the sell side or on the buyer side. Because end of the day, deal making is not about just financial models. It's about how to make two people, as Rakesh said, a marriage work. So I thought to give that thing about the culture aspect. So without much ado, I'll invite Alok, who will talk through about the aspects of commercial due diligence. So over to you, Alok.
Sure, Santosh, you can just take us to the slide number 40. I think while he does that, I think I'll just pick on, I think, both Raja's as well as Rakesh's comment on post-merger integration. I think just for the group, one of the seminal groups which has done 150 plus integrations has been the Danaher group, and through that I think they've been fairly successful at that. I think they have probably have created the kind of value they have created is maybe second to none, or maybe competes very closely with Berkshire Hathaway. Something that they actually do as part of the integration is something one very close to my heart as well, in terms of they have termed it as a Danaher business system. They integrated using concepts, and I think there's a Japanese term for this, Koshin Kanri, which basically aligns the company strategy to the KPIs of the leadership, and then down to the functional level to the operating person. What that does for you is it actually makes sure the alignment is complete. So I think that's definitely, I think, something to kind of look at. I think that's a great one. We also kind of do that on our engagements, and something very close to my heart. Coming to, I think, commercial diligence, I think, and given the fact that this is primarily a CA audience, I think, and something that comes very close to, I think, the sensibility of this group is the responsibility that, whether it's a fiduciary responsibility or otherwise, that the client reposes on you. Here, I think the responsibility of commercial diligence is to make sure that you represent the true future of the company, in terms of, I think, the basic premise of a commercial diligence is to see what is the future outlook for the company. That's basically what it is. It's different from financial diligence, is looking at the historical perspective, whereas commercial diligence looks at the future growth prospects of the company. That's the primary kind of objective of commercial diligence. And I think from I think integration standpoint, I think it also feeds into the valuation, because once you have the prediction, then I think the valuation can then look at those aspects, and also look at comparable companies, look at other aspects, and then come out with a valuation as well. So this could be a one feeder into the valuation exercise also. The other question the group might have in terms of where does it really start? When do we need to do a commercial diligence? And I think Santosh brought it out in terms of the overall deal making process, but I'll just reiterate that once you are done with your initial deal origination piece, there is the initial meeting of the minds that has happened. There is, let's say, a term sheet that has also got signed with some basic agreements, and then you get the right as a buyer or as an investor, the ability to then do further due diligence. Sorry. Okay.
Yeah, look.
Yeah, there was a voice in the background, so I think. Okay. All right. I'll start again. So I think so. After the deal origination process is done with I think maybe a MOU gets signed with basic principles of agreement, but then I think a lot of things that needs to be trued up, and that's the phase of the diligence, whether it's financial, whether it's commercial, legal, or otherwise. So I guess commercial is at that stage, and then it feeds into the valuation, as I said, so that's where it is kind of position. Can we move to the next slide? So when we do that, the commercial diligence will want us to look at both from an inside-out perspective as well as outside-in perspective, and I'll elaborate that. So outside-in perspective will be in terms of what is the market outlook for this company? Is it really going to have the tailwinds, or let's say there'll be headwinds which will impede its growth? So we will look at that standpoint and distill it from a company's perspective. At the same time, we'll also look at from an inside-out standpoint, what are the capabilities that this company has? Are they really aligned well to take care of the advantages, let's say, that the external system, the market is actually posing? Does it have a right to win in the market it operates in? So those are elements that are really, really important, because I think, as Rakesh rightly pointed out, uh, 1 plus 1 equals 3, right? And here I think you are really looking at a business which has that potential, maybe with certain operational or let's say some other elements, that synergies that the deal brings in, it will be able to at least reach to a next level of growth. So I think that's very, very critical in terms of trying to identify whether this company has the right to win. And obviously there are elements of other aspects that comes into play, uh, maybe synergies of sorts, that could be questioned. Now, when we do the commercial diligence exercise, we might have a company that maybe having 6 different end user industries, might have 3 business lines. So it could be a fairly complex, onerous task. The timeline could be 3 to 6 weeks. So how do you actually then accomplish this exercise within that limited time frame and do justice and answer critically for the client in terms of, is this worth going after? What are the prospects? Maybe create 3 different cases, maybe optimistic, conservative, pessimistic, kind of with 3 different outlooks you can create. So what you essentially, you can't really boil the ocean doing 6 end user industry analysis and maybe 3 business segment kind of deep dives. What you do smartly is we start with the first week when you actually look at the overall market outlook. But what you essentially do is you have a hypothesis even before you start the engagement. These hypotheses essentially could be on scalability, on profitability, on sustainability. These are broad 3 categories that probably will be in the mind of any investor. And then you detail it out specifically for that industry in terms of what does it mean. And you come into an alignment with the investor, with the potential buyer, saying, okay, is this really some of your key questions and asks? I think once you get to an agreement, then the exercise becomes much more targeted. And I think that's where I think you will then, let's say, go from the first 2 weeks of overall market assessment to, let's say, a hypothesis testing, when you will actually test each hypothesis and see whether that's a valid hypothesis or that the data doesn't support that. So I think you are not wedded to that hypothesis. You just want to make sure that you are giving that true picture to the client, saying, okay, all right, to the buyer, potential buyer. So that's, I think, is the hypothesis-driven approach, and we'll take an example of that. But at the end of, I think, hypothesis, this will then feed into a business plan, and the 3 scenarios, as I said, could be a pessimistic, a conservative, and optimistic scenario, wherein they could be interplay. And I think it becomes all the more relevant in today's day and age, because what we are seeing right now is an uncertain environment, right? We are living in a VUCA world, volatile, uncertain, complex, ambiguous, right? Volatile, the markets have moved crazily, and I think in the last 3 months they would have had the ups and downs that probably wouldn't have seen in the last decade or so. Uncertain in terms of there are supply chain, demand is uncertain. I think complexity, ambiguity probably will come from the standpoint of the supply chain or the ideal response to COVID. So I think in that scenario, I think it's good to have at least maybe a pessimistic scenario. Maybe I think it's not a V-shaped recovery. It's obviously, it could be a U-shaped, most likely, or let's say in the worst case scenario, it's L-shaped recovery. So it takes time, right? So I think those 3 scenarios can be modeled, and that's where I think you can build up those overall different business plans around that. And I think that is something that can be shared. Can we have the next slide? So I think this just showcases a cross-border commercial diligence exercise for a healthcare tech company that we had done for a leading conglomerate. And I'll just point out, one is definitely, I think our hypotheses were cutting across scalability, across profitability and sustainability. But I think the business was having both, maybe part of the business was more BPO-centric, part of it was more analytical driven. We wanted to see whether, I think there were, I think the margins for the analytic business was, I think, very different from the BPO part of the business, or let's say much more standardized or process-based kind of. So that was definitely, I think, one inquiry that we did. And I think there were very, very interesting insights that we brought out for our client. Because you have to see whether, I think it's more in terms of from a positioning standpoint that the business has been maybe there's some numbers which are not holding up. So I think we did that. The other aspect was from an overall market standpoint, whether there is a value that this client was making in the overall ecosystem. So this is for the US healthcare market, whereas the per capita spending on healthcare is the maximum, whereas I think from a top 10 country standpoint, the effectiveness is probably number 10, or yeah, top 10. It can't be worse than 10, right? So from that standpoint, I think definitely there was aspect of the efficiency that could be driven, and this company was focused both on the pre-claim and the post-claim audit process. So I think that I think is also important to demystify in a commercial diligence engagement in terms of what is really driving value for the, and as I said, the right to win for the company. So I think that's definitely we did that, and I think we did that with proper understanding of the US market with our member firms based out of the US, and I think also along the way, I think one of the things to share is also we were pretty much in touch. Here was a case where the financial diligence was being done by another party, the legal was being done by another. So there were different players, but we integrated very well in the 3 to 4 week kind of a period, wherein our findings were being shared, or at least the highlights, and they were comparing, contrasting from one team to the other. If you're holding it all together, you will definitely coordinate within the teams. But even otherwise, I think there is merit to really make sure that the output of one is actually being leveraged by the other teams. So I think that's something that we did. At the same time, I think, as I said, there will be times where I think you will have to show the mirror to the client, saying, okay, there are red flags. And I think that's really your responsibility to show the red flags to the client. And that's what we did as well along the way, in terms of, and we raised it, and I think client really appreciated that as well. There was, I think, we had to be really diligent, because I think this was a big deal in terms of from a client standpoint. But I think you have that responsibility, and that's why the client engages you to give that unvarnished view as you either the, and should be open to the feedback also. It's not as though your view is my view of the highway, right? My view of the highway, but it is, you should be open. But at the end of it, if you're not convinced, you should say that, okay, I think data does not really support a view which is different from what we present. So I think that's important. I think so those are the critical learning points, I think, from a commercial diligence standpoint. And I think the hypothesis approach keeps you focused on the effort. So I think those, I think, Raja, for some of the thoughts I want to share with the group.
Great. Thanks, Alok, to kind of bring the perspective of commercial diligence. I guess you covered 3 S's. I actually missed out the last S. You talked about scalability and sustainability. What was the third S?
Oh, that's a profitability. That's a P. Yeah.
Profitability. Okay, right. So profitability, scalability, and sustainability. And I guess fundamentally you refer to the hypothesis, which is nothing but assumptions, right? Which again, drawing to what we started today and what Rakesh said, that why are we doing this deal? So what are the assumptions based on which we are doing the deal? And the commercial due diligence focuses on these aspects: profitability, scalability, and sustainability. And I guess you also talked about the business plan, right? How to build those scenarios into worst case. And I guess in today's time, it's all the more important because it's very difficult to even predict what's going to happen. So one question for you, Alok, given your experience on several transactions, is in today's scenario, how would you go about doing a business planning? It's very unpredictable, right? So is it by sectors? Is it by different lens you would do?
No, I think one is, see, from a business standpoint, I think there are maybe some operating models are changing and there may be new ways to market are happening. Fundamentals doesn't change, but at the same time, I think one, the variance between a worst case and the best case could be very wide. I think needs to be so. I think one will need to look at the sensitivity of these assumptions much more, because earlier it was not going to be that wild. It's going to be, I think, within a certain band one could really see. Here, I think certain industries definitely are very, very badly affected. So for them becomes very, very difficult in terms of, so you will have to then have those scenarios set out. There are certain, I think, industries, let's say on the tech side, they're probably even having an upside right now. So I think for them it's business as usual. We will probably do it normal way in terms of what are the growth enablers for them. So maybe this environment for digital transformation is a growth enabler. Somebody who's actually involved in digital transformation efforts, or let's say on maybe even on the cyber security aspect, because everybody has moved online. So I think cyber security becomes important. So I think for the most part, methodology doesn't change, but I think scenario analysis becomes very, very critical.
Sure. So fundamentally, fundamentals don't change, your principles don't change, but how do you build sensitivities and use those judgments on the business planning? That becomes far more critical in today's time. Great, Alok. Thanks for that. So Arpit, is it possible to have the poll questions? Is it possible?
Yes, we can launch the poll here. Welcome Rakesh ji once again. Thank you for joining us again. Also, before that, Rajesh ji, can we take some question to Alok ji? There are two questions that have come in.
Sure, please.
Because so one point that you mentioned on sustainability, if a KMP, a key management personnel, leaves the company, who is very important part of the business process, whether the DCF based valuation will hold good in this context? Madan Ahuja ji has asked this question.
Yeah. So I think it's a mix of both commercial as well as, I think, post-merger integration piece, right? So even though it's called post-merger, some of these things are highlighted right up front. If there is a key man risk, we actually, from a commercial diligence, we will cover it, and we, at the end of the commercial diligence, we will have a complete scorecard that we present. And if the key man risk is substantial, then I think we will highlight. Same thing will be picked up as a post-merger piece as well, wherein I think that even before the deal is closed, you will identify the key people, and you will make sure that that doesn't really happen. Obviously, in the real world, it might still happen. You might still not be able to retain the people. So there is a risk which gets highlighted in the commercial diligence as well as from a post-merger integration standpoint.
So as a consultant, So as a consultant, how would you factor this in your due diligence process?
One is
How much do you discount?
Maybe I think if it's a risk that we, in terms of that needs to be factored in the worst case scenario, then it could really come into play. And if it's a real risk that, okay, I think maybe you have a high probability that the management is not going to stick on. And I think maybe it might just be, I think there are certain aspects of integration as well. So I'll just take a minute in terms of when you integrate companies together, or when you intend to integrate companies together, you need to see a couple of things. One is, what is their need for autonomy? If the need for autonomy is very, very high, and need for interdependence is low, then you would keep them separate, because I think what you lose is when you integrate them, absorb it, right? Then you'll actually lose the value. So companies like Cisco in the technology sector, they will not integrate it that closely. They will retain the existing leadership, and the existing leadership is also pretty much okay with coming on board and not losing that autonomy. So I think that's very critical for these kind of tech companies, wherein you don't lose value even though you get the capability. So I think Cisco actually does it very, very well. When they acquire companies, they almost say that you are actually maybe a gift to mankind. So I think they take that approach, and with that, what really happens is there is obviously a cross flow of ideas, and they are able to retain the talent. So that's one. Whereas in, let's say, if you're a BPO acquiring another BPO, it's probably from a geography standpoint, it will be absorbed because you are good looking at scale, and I think that will be looked at. So I think the level of integration will also determine what
Sure.
what approach you take. Yeah. So I think
Sure.
that limited point. But in terms of totally factoring in, I think we will highlight it as a risk. But I won't say okay that will actually maybe we will, unless there is a real possibility. I think the worst case scenario we will not look at it.
No impact on the valuation. So there will be no impact on the valuation as such. Maybe a risk that we could highlight.
It's a risk, and again, you have a band of, I think, more from a overall ratio standpoint. Yeah.
So we've got one more question to Santosh ji. When you spoke about all these M&A and these, so largely, so the audience today that we have is more of a practicing chartered accountants. So what do you feel? So Pranav Bastawala has asked who are normally the team members. So what should be the type of team members that we should have, and what is the rough size of a team required for doing due diligence for making such a deal? Now, such deal is maybe in a presentation, but maybe if you can give a broad highlight of what kind of personnel do we want, and what should be the mix and the size for doing a good M&A advisory.
Okay, so essentially the question is what kind of team you would need to run an M&A practice, correct?
Sorry? Yes.
What kind of team you would need to do an M&A practice?
So suppose you've got it. So what the question says? What kind of a team do you need? What is the mix of the team that you should have, and what size should it be?
I think as a CA, I'm sure I think we are better placed to do a M&A practice, primarily because we are able to understand both from a finance, accounting perspective, valuation perspective, as well as the deal making perspective, which includes legal, tax, and corporate secretarial part. So any CA, any good CA can be a good M&A advisor. The most important point he would like to probably add to his capability is the understanding of the market, the operational aspect. That is something which would normally they are good. MBAs are good with presentations, with financial projections and analysis. So a good combination of both CA and MBA in a team will go a long way in making a effective M&A advisory firm. That will be my view.
Right. Thank you. And on this background, we've just launched our first poll. Rajaji, we've just launched the question: to what extent do you think M&A activity will decline in the next 2 quarters? I will request all the audience to please participate in this and give us your. So you can click on the radio buttons A, B, C. So A is more than 50%, B is 25 to 50%, less than 25%. Decline of M&A activity in the next 2 quarters. Rajaji, what is your view on this? Or maybe before you, if Rakesh ji can tell us from an industry perspective, what is the size and what is the kind of team does he believes that can be a very handy team for a M&A exercise?
This is a question for me.
Yes,
Yeah, Rakesh.
Rakesh. Yeah.
Maybe an industry perspective as well. from the other side of the desk, what do you see?
It's a very subjective point. So let me explain you. You normally see now in my case, for example, I had the strategy, M&A, new businesses, alliances, all of it. So you normally have a team which does all these activities, strategy, planning, M&A, new businesses, alliances, partnerships, development, all of it. So because you won't be having M&A all the time, right? You normally do maybe one or two M&A, maybe in a year or two, but then you can't have an exclusive team for that. So normally a team of, let's say, 4 or 5 people is what is ideal. So let's say I have a team of 5 people, and like out of those 5 people, 3 of them are chartered accountants, couple of them are MBAs. So that's how we and then we have a rotation between the team. 1 year you will do the budget, let's say the other year you will be part of this exercise. So that's how we do it. And normally what we do is after 3-4 years of experience, we then move them to operating roles and then again get a fresh talent. So you always have 2 junior people who are like fresh from college, fresh MBAs, or maybe 3-4 years of experience, who are good on, let's say, modeling, who are good on Excel. So that's how we essentially look at it.
Right. Thank you. Rajaji, we've got the answer. Just close that almost around 80% of people have voted. So 10% of them voted for more than 50% decline. 37% have voted for 25 to 50%, and 53% have given a very good impression that only less than 25% decline would be there.
Fabulous. So I guess that's pretty much. I think that's a great insight from the group. Thank you, everybody, for giving. So it very clearly means that it's not doomsday. There is clearly a lot of M&A to happen. That's what we have been discussing. So I think that's great. But I think a question, I'd like to ask Rakesh, which I couldn't finish, you to leave, is one is the team size. But let's say when you're, let's say, selecting an advisor, right, for your M&A, for example, whether it is a due diligence, it is a valuation, or an investment banker, right? Can you hear me, Rakesh?
Yeah, I can hear you. Sorry.
Yeah.
Sorry.
So no problem. So the question I couldn't complete because you had to leave is when you're selecting an advisor, right, for M&A or due diligence or evaluation, when you're selecting that, right, more than the team and all of that, numbers, that's one thing. But what are the qualities that you're looking for? How do you select? So what are the 2-3 things that you see when selecting an advisor?
I think that's a damn good question. And so I think three or four, I would say, key criteria. One is obviously the experience of the team in the same sector, because if I'm doing a consumer deal, I would like the person to would have done, because I would normally do larger transactions, and I cannot experiment with somebody who has never dealt in this. The second, which is most important, is I want an advisor who will call a spade a spade. I really respect advisors who tells me don't do the deal. A lot of times what happens is a lot of advisors do things just because they want to get the deal done and they want to get a fat fee. I have seen in my experience, especially Tata's, we are very, very cautious and we are choosy about our advisors because we want them to tell us the right thing, irrespective of the fee. And there have been some cases where what we normally do, even if you're doing a diligence, we always we divide the stage into 2 parts. One is the red flag stage, because where it says that, okay, even if you find something which is very fishy, you raise a red flag, and we don't move ahead till the time we solve for it. So that's how we divide our diligence. And most of the time we have seen that red flag strategy has worked really well for us. And we have not done the deal because of that, and we are happy about it. And we really appreciate those advisors who help us to do this. So that is number 2. The number 3, which is very important, the advisor needs to have a full view of the entire structure. So a lot of times, there are certain advisors who say, "Oh, I'll only look at the tax aspect," or I will only look at the financial accounting aspect. Somebody would say, "I'll only look at the commercial aspect." You need somebody who has a 360-degree view of the deal, and then only the deal gets consummated. Because because there are multiple issues in every transaction, so the visibility of the various multifarious issues that comes in front of us is very, very crucial. And so these are the three things, honestly, I will look when I look at an advisor.
Perfect. No, that's a great insight, I guess, for all people on the call. So sectors, do the right things, and red flags you talked about, and full view. So not just siloed approach, somebody who can get that. Great.
I think
Thanks a lot, Rakesh. Yes.
that's quite helpful. And Rajaji, immediately there's a question for you over here, since you are one of the important consultants in this space. There are people who are asking that how can they as fresher get exposure to this, and what are the basic things that you seek, or maybe before hiring. So as Rakesh ji mentioned, they would also want to hire some junior people, move them into this role, and then go switch over in operations role. So in consultancy space, how do you figure out, if at all freshers? So there are MBAs, there are chartered accountants largely. What is your one point of maybe an advice or suggestion, or any courses that you should suggest, or anything that you should? So for example, on modeling or this or that, whatever. What's your take on this?
Yeah, I think on a CF platform, I would definitely say that, and I'm not just saying because it's the institute here or we are all chartered accountants, but I would definitely like to say that chartered accountants are possibly best suited to be a deal maker. I'll tell you why also.
Without a doubt.
One,
Without a doubt.
because right, Rakesh will not bat an eyelid for that, right?
Without a doubt.
Without a doubt. And please come in, Rakesh, to give your views here.
Yeah.
Because
No, I
one
think.
is, please.
Yeah, please go ahead. Please go ahead. No, it's okay. I don't want to steal your thunder. Please go ahead.
No. My whatever
Actually,
will come
there's
after.
another question that is coming to you after this. So yeah, Rajaji, please go ahead.
Okay.
No,
That's what I'm saying. You can go ahead.
So I think one is clearly understanding of finance. I think that's very, very important, right? I think all of us, if you look at it carefully, I think from the start we said how important is cash, how important is financial modeling, business. But end of the day, you got to understand finance. See, in a deal, it's end of a transaction. So the best is a chartered accountant, in my view. So I guess very critical is that understanding finance. I think two aspect, at least my personal view is mindset and attitude. See, whether you're a chartered accountant, you could understand finance, but end of the day, how are you open to collaborate with a lot of people, work with a lot of people, have the mindset to learn every day, right? Even if you're the best deal maker in town, you will learn something new in one transaction or meeting and interaction. So how are you on the mindset and attitude? Very important, I feel. So having the right attitude more than anything else. And third, which I've always believed, business. And that I learned, I still remember from my articleship days, is if you understand business at every moment, automatically you will be a great deal maker. So finance, attitude, and business. Over to you, Rakesh.
Won't like to add too much. I think in my view, the most important thing is understanding the numbers. See, a lot of times what happens is, when you are a painter, you get lost in your own painting because you have your own vision, and not many people can see it. So I think our ability to look at the numbers and not just look at the numbers, but interpret them, in our own way to say, okay, these numbers are real or unreal. Because when we look at a balance sheet, the first thing that we look at is, it's a balance sheet. Don't show me the P&L, show me the balance sheet. Because, a lot of people don't ask this question. And I have seen transactions where they will show me a sheet where they will show me EBITDA and they will show me cash. I said, where is the balance sheet? It is a ruski kya zaurat hai? Boss, bina balance sheet ke, there is no discussion. Correct. So the first question that you ask as a CA is balance sheet, but that you will not find others. They will always like to look at the business model. They said, please send me the model. We say, please send me the annual report. So that approach is different because that's how we think. That by the end of the day, your balance sheet should match. If you are making money, then it should either be in cash or it should be in your working capital. And if it is lying in working capital and it is not in cash, then you are on a good business. You might have great margins, But PAT
Absolutely.
is equal to cash is a concept that only us can think about. Not many people
Absolutely.
think about.
Yes.
So I guess that's the key difference. And it's a great thing which has been learned over a period of time. We obviously find it very easy and funny, but it's very difficult for people who have not gone through this process of learning a balance sheet. They can't figure it out. That how do you guys do it? But obviously we have learned over a period of time, and the rigor that we have gone through during our articleship days, during the CA course, and during when work for an accounting firm. I think that's great. That's a huge asset that I think CA as a profession has, and actually been using in all the large transactions in the country today. So if you really look at it, all the big transactions, all the big ones, they're just not possible without an accounting firm. Number one. Two, the biggest deal makers in this country are all chartered accountants.
Yeah.
Absolutely. So there you
So
go,
Rakesh,
Arpit.
this is a correct statement to make that you don't choose a career of M&A, you get into one or you evolve into one. Isn't that would be a correct statement to make?
Yeah, see, it's like this. Let me just give you that example. See, I think the Raja made a very interesting point about the Japanese who said, "What is an M&A?" So the question is, it's not about you say, "Okay, I'm an M&A lawyer" or "I'm an M&A deal maker." It's about essentially creating something out of the various options that you have, right? And I started my life as an investment banker, then I became an investor, and now I'm part of the corporate world. So, but if you really think about it, I'm doing the same thing. One might say, "Oh, I was an M&A advisor. No, I was an investor, but now I am running a business." But I'm doing the same thing because I'm using my expertise in various fields. And I couldn't do an M&A till the time I understand the business, right? I will not be able to do an M&A if I don't know whether I'll make money out of it or not, because there I will need my investing skills, and I will never be able to consummate it if I was not an investment banker, if I had not done a deal in my past. So it's you have to obviously you evolve as you rightly mentioned that you don't get into a role but evolve in that role, and that role gets upgraded year by year. So you do a smaller deal, then you do a bigger deal, and then you do a much bigger deal. So that's how it happens with all of us. So it's a process, it's a journey, and slowly and gradually you will reach there. If you think that you can go and do $1 billion deal on day one, I don't think that's possible. So, so I would say it's a slow and gradual process that we all have to go through.
Absolutely.
Right. So next question. Thank you, Rakesh. Next question is to
Yeah. So Arpit,
Santosh.
just to make sure that we are okay on the flow. So there is one aspect that we haven't covered. I'm conscious of time.
Oh, is
Is
it?
on the
Oh,
financial diligence. Yeah. So
oh
I just
yes.
want to make sure that we cover that. Maybe it'll take 10
Please go to
minutes
the.
and then come and
Right.
conclude with questions,
Oh,
because
yes.
I just want to make sure that we cover what we've intended
Do you want to take those two polls also while you start talking about the
at the
financial?
last.
Okay, cool. Please go
Yeah.
ahead.
Yeah. So just conscious that we cover that, and then obviously be happy to do 10 minutes. So so is it okay to to give control to show the slides?
Do you want it?
Yes.
Okay. In a moment. Go ahead.
Can you see this or not yet? I
No,
guess.
no, not yet.
Okay. 1
Mhm.
second. Yeah, I think it's not popping
Right.
up on my screen.
1 second. I'll do it again. Just check this now.
Yeah. Yeah, not yet.
Okay. Mishra ji,
Uh,
can you please check this once?
or I may request Santosh to try.
If Santosh can, I can give him the
Yeah.
presenter
Yeah. The
rights.
only thing is it will, we'll have to change the presentation quite a number of times.
Yeah.
So maybe Santosh can try. It's okay.
It's come now.
It's come.
Yeah, yeah.
Oh, okay. And you can see due diligence.
No, no, I think Santosh is running it. Learning
Oh,
from
sorry.
leads.
Oh, okay, okay. Sorry. Okay. Okay. I am not able to see the screen. I guess it's an issue from my side then. Yeah.
No, now can you see it?
Yeah.
So
Yeah, I can. Yeah, I can see it. Yeah. Okay. Okay. I
What is the
can
slide
see it
number you
right
want me to
now.
go to?
Yeah. Just go to the due diligence section, please. Just go up, please. Yeah. If you can go up. Just to the due diligence section. Okay, there's some issue on my screen. I can see only assess normalized earnings.
I'm trying to.
Can you hear me,
Yes,
Raja?
sir.
Yes.
Yeah, Rakesh.
I think if it works for all of you, why don't we just stay with Q&A, because that will probably
Yeah.
save time and maybe help people to
Yeah.
ask questions, and we can
Yeah.
just leave it.
Yeah.
I think the technology is got a little overworked here.
Yeah. Yeah. I can see that. I can see that. So I think before we get to the Q&A, I want to just cover 5 minutes, and I'll just talk it
Yes,
through
please.
on the financial diligence.
Yeah.
I think you
Yes,
can knock the screen off, Santosh. Take the
you
screen
may
off.
just start, Rajaji, you may just start if at all
Yeah,
you
I'll
will.
just start it off. Yeah, exactly. So I guess one aspect we definitely covered, as I think Santosh talked about, Alok also talked about, is how important is due diligence. Okay, it's coming in now. I don't know after. Yeah, is really about due diligence, right? I guess you've been able to see the screen now, right?
Yeah,
Yeah. So I
So when
guess
you don't.
yeah. So I think 2-3 takeaways, and obviously the presentation will be with you, is I think before doing a deal, which we talked about, and closing a transaction, the only thing that stands in between is due diligence, right? And if you look at the kind of surveys, learnings from past deals, the biggest failure of deals, unfortunately, has happened a lot to do with due diligence, not great due diligence done. So very clearly, that's one of the most important deal activity in the process. And I guess as chartered accountants, as advisors, and I'm sure a lot of us are here, play a very significant role on due diligence. I think I'm not going to go through all the slides, but I think 1, 2, 3 points I would like to mention. I think one is common sense. I think we can do, as Rakesh said, I think Arpit also said that we can do all the great financial models, business plans, extreme great analysis, but clearly common sense is critical. And unfortunately, common sense is not so common nowadays. And I think there, I would like to just highlight that in one case scenario, this was a deal that was a cross-border transaction for a large IT company, which was buying an asset in the US. And in that scenario, basically when the due diligence was happening, financial due diligence was happening, as you can imagine in this kind of a scenario, it was not a very large deal. It was a $25-30 million transaction. And there were close to 20 people. So this was a debrief of the due diligence session going on. And people were talking about customers, brand, valuations, and all of that. And a very junior member of the team said, I've got one observation. And the observation was very simple. The observation is when they looked at the income statement of the company, of the target company they were planning to acquire, they saw there were expenses relating to MBA education, right? MBA. And as you can imagine that in the US, MBA education cost is quite significant, is at least $100 to $200, $300,000. So it's quite significant. And so it was not a very significant observation. But the deal maker who was heading the transaction said, no, I want to know more about what the observation is. And they found out that this was nothing but basically a way to bribe the customers. So what they were doing was they were actually paying customers, not through other means, but basically supporting the MBA cost of their children. Not big amounts, but fundamentally what the company said that everything was great. Financial valuation was great, business plans were great, top customers, but they said we can't compromise on governance and ethics, right? I think the point, ladies and gentlemen, here is that when we do due diligence, one doesn't really know where the top finding will come from. It could be a very small, but it could lead to various symptoms of what you're buying. So I think look out for those small things which may not be apparent today, but will become relevant for your deal tomorrow. So I think that is one. I think the second thing I want to highlight to you is about another situation. Is really about one of the top deals that happened globally. It was a deal of $10 billion. Okay, $10 billion in 2010. After 1 year of the acquisition, the deal had to be written down by $9 billion. So it was $10 billion bought. After 1 year, the impairment was $9 billion. $9 billion. So it was only valuation was $1 billion. It led to huge issues, class action suits, etc. As a US listed company. But the main issue that came out was fraud and revenue accounting. And the second key point was not enough due diligence done. Such a large company, due diligence done in only 3 weeks. But fundamentally a big fraud that came out. And I guess the point here is a lesson that I learned from one of my friends who runs a private equity fund. And he said, when we give money, and this was a very large fund, and they write large checks, and he gave me a very important lesson. I remember 15 years back. And he said, Raja, when we do any transaction, right, we can compromise on valuations, we can compromise on certain things, on earn-out arrangements, on tax and all of those legal clauses. But there's one thing we don't compromise on, that is the time to do due diligence. And we don't fall under pressure. So I think, ladies and gentlemen, end of the day, right, I think we got to be convinced about what you're saying, because inner due diligence is the only phase. If you're not convinced during due diligence, more often than not, it will hit the company or the investor at some point or the other. I think that's all I wanted to say. I think the presentation would be there with you around various aspects about due diligence. I know there is separate sessions on due diligence. And I guess I would say that some skills, and I think Rakesh talked about it, I would say the last thing I talked about, the Poirot factor. Hercule Poirot was a famous investigator, right? In a due diligence and in a deal maker, I think one of the key skill is a power of observation. Power of listening, power of observation, the ability to pick up things and connect the dots, and common sense, as I talked about. And lastly, to conclude, this is Donald Bradman. Everybody knows about that. 99.99 average. The left side of the photograph is basically going to bat his last innings. His last innings, he scored a duck. But Donald Bradman said one thing, that when he was asked what he will be like to be remembered as, he said just one thing, the most important thing that I would like to be remembered as a person of integrity. And he said that you can have the greatest skill in the world, but important is integrity and modesty. And I think I would just want to lay the conclusion to say that as a deal maker, as the deal journey goes through, I guess the elements of integrity and modesty, and important to oneself and your organization, will be pretty important at the end of the day. So that's it from my side. Back to you, Arpit, and we can move to the questions.
Oh, that's quite spirited approach. The integrity and the modesty both have to be of prime importance, and especially when, as Rakesh ji mentioned, you should have the ability of calling a spade a spade. And friends, we are all in this world, and in various, not more than many more than one ways, we are here advising some or the other people. May it be acquiring an asset, may it be acquiring anything, maybe not even a company, but a small little aspect by a promoter or whoever. But yes, what differentiates us from others is this ability of calling a spade, and of course the integrity, as Raja mentioned. Superb.
Okay.
Let's get on to these questions. Yeah, sorry, anyone wanted to speak
Yeah, I
something?
think Raja is still sharing your screen. You can probably.
Okay, sorry. Okay, yeah,
Yeah, no problem. Okay, yes.
yeah, okay, yeah. That fine now?
Yeah,
Yep.
yeah, perfect. Okay. Um, so one of the questions that has come in, maybe if Raja, you can answer this question. Hospitality sector. So Nishchal, no, sorry, Ramesh Chaturvedi has asked this: is it a good opportunity for acquisitions in the hospitality sector, given that the investors might get good business at lower valuations now?
Yeah, I guess we touched upon that. Lower valuation, in my view, cannot be a driver of a deal, right? Look at the
Wow.
drivers, business underlying drivers. If the business is good, look at the value and not the price. So if the business doesn't exist, so even at a lower price doesn't make sense. So look at the business carefully.
I think this is a change that we need to have in our mindset. Being into practice, we need to really look at this larger picture of really having a much more than just a value or a price. I think that business, the essence of that business is something which is important. So maybe if someone would have got into a Seven Hills, would have really at a very low valuation, would have had a very tough time. So maybe not.
Absolutely.
Okay, Nishchal Mittal has a question. Santoshji, this is for you. Company A has given loan to company B. Now, company A wants to acquire that company. The valuation of the company is more than the debt given. Can we adjust the debt amount against the amount paid for equity, to be paid for equity, and how to do due diligence in terms of adjusting debt with equity?
Adjusting debt with equity.
Can it happen, first of all? So, Nishchal Mittal has asked this question.
Uh, yeah, debt and equity are two different amounts. So debt and equity, debt carries a different cost of capital. Equity has a different cost. So it is not advisable to substitute debt against equity. So, or let's say, put it in the same platform. What we say is equity is costlier than debt. So that's the reason why probably whenever the transaction happens, equity value is on the higher side. But the question is about how you value an asset or how you value a business, whether debt is adjusted against the valuation. Yes, debt is definitely adjusted against the valuation. So cash is also adjusted against the valuation. It can be a positive adjustment, it can be a negative adjustment. So at the end of the day, it is netted off. So, but kindly don't keep debt and equity the same platform. These are two different entities. So both of them carry a different cost to the person who's taking that particular fund.
All right. Uh, some of the edutech companies have been taken over at very high multiples and valuations in these times. Will they be able to continue to justify such investment for the acquirer after the pandemic, say 1 year down the line? So, do you see this online mode sustaining itself?
Maybe Rakesh, you want to come?
I think that's a good question. So I guess, if you look at the deals that are happening, and I mean, look at White Hat Junior, $300 million
Yeah.
in 18 months time. So they are all, if you ask me, is addressing the need, and clearly people are looking at distance learning, and it's not that distance learning was not there. It has been there. I still remember there was this Z group started Z learning, if I'm not mistaken. They used to teach through TV. correct? Maybe that was ahead of its time, and I think so. But if you look at what a White Junior Hat has done is they have looked at a particular section or unmet need of the requirement and building over that. So I think uh, the sector is going to be there for a long time, but you will find them, all of them are basically meeting an unmet need somewhere. You will not find a lot of, I would say, e-com players or a marketplace players attracting a lot of capital, but you will find niche players who are sort of creating a differentiation. So whether it is, there are multiple companies in the financial services space who are basically providing hyper local, the last mile connectivity. So those are the businesses you will see a lot of traction. You will, in my view, there is too much of, I would say, too many players in this whole Paytm and payment space when none of them are actually making money. And obviously, the e-com place is now being dominated by two large players. So I don't see anybody who gonna come there and sort of raise capital. So in my view, it would be more driven in niche segments, and which is basically looking at the unmet requirements.
And also, Rakeshji, as you mentioned, White Hat Junior, for example, last 3-4 months only that, there were these massive advertisements and approach to coding, learn coding, this and that.
Yeah.
And, in the same time, this is when the deal happened. So, they might have, reached out to so many people, they would have got database, but not essentially many people would have really joined those courses.
Correct. No, but to be honest, if you look at the numbers are quite astounding. And Byju's bought them. I'm talking about the revenue numbers. So the numbers that they were clocking, if you look at it was not an expensive deal actually. So if you look at the deal numbers, they were already clocking very healthy numbers. I thought in FI, I mean, as per the run rate, their revenues were between 30 to 40 million dollars. And if you look at the way they were clocking the revenues, it was not a most expensive deal that you would see in that space. Is the point.
Okay.
But you will see a lot of consolidation. Again, see, Byju's, it's about somebody who already has raised so much of capital. For them, basically not paying off from the cash that they're generating. It's the capital that they have to deploy this capital. Because see, for example, Byju's is today quoting at, let's say, 10x of revenues. They are acquiring something at 4x, and they are on day one. They are, so there is a instant arbitrage that is being created when it comes to this kind of acquisition. But these are honestly very crazy times, and I don't know how would you justify this kind of numbers, because at the end of the day there is no cash, there is only gas. If I may call. So one have to watch, to be very honest. But yes, deals are happening in this space right now.
Okay, Alokji, there's this question to you. Harshal Narwani asks, early stage companies are facing lack of funding with VCs and angels, being excessively cautious. And even banks are not very keen on funding now. So not very early stage, but the ones eligible for round C or D or PE investments. So do you feel this will sort of increase boost in sell side with a lot of small companies and acquirers can strategically look at these opportunities?
Arpit, can you just restate the initial part of the question?
So I'm saying since the avenues of funding are not very forthcoming these days, so the ones who are eligible for round C or D, so the third, fourth, or the PE investment rounds, so these sort of companies who have got initial funding or something, but now they're not able to, leverage, or they are not able to get more funding. Do you see a lot of opportunities in, deal making with or acquiring these kind of companies because they are now stuck? And can acquirers strategically look at these opportunities?
So my sense is, again, goes back to the critical question of the sound model, right? If it is just for lack of funding that I think their growth is limited or they're facing a challenge, those things should be looked at. But I think it goes back to the basic drivers of the business. The fundamentals have to be right, and then I think I think then there will be people who will be willing to kind of invest, and whether it's an acquirer or somebody else. But at the root of it has to be a sound business model. Rather, you want to add?
No, I think you've hit the nail on the coffin. Sound business model. I think that's obviously critical. But I guess specific to private equity can't raise. But most funds who have invested in various companies, there is definitely a play of consolidation. So if it's an investor, invest in company A, company B, similar space, complementary, they're merging it together. So I think consolidation will happen, and that's the way of the game in the next couple of quarters.
Okay. Pranav has a question. What is your opinion on ITC's acquisition of Sunrise business at 2,000 crore valuation and the value potential from ITC's point of view? Maybe Rakeshji, you can take this question.
Yeah, I think that's a good question. So there is a big. So let me just give you certain facts and figures about the spices as a sector, and that will probably give you a sense why it makes sense for ITC. If you look at ITC history, they have built most of their businesses organically. Okay, I mean, whether it is Ashirwad, whether it is Sunfeast, whether it is Bingo, Yuppies, everything that they do today, they are all through organic. But today, the total revenues from the FMCG business, which includes FMB, is close to about 14,000 crores. So in fact, if you look at, they are the largest FMB company in the country. Nestle is number 2, and Nestle's revenue is about 12,000 crores. So not many people know this, but ITC is now probably the largest FMB. What they have also realized over a period of last 20 years, because that's when they started their journey, and they have a stated objective. If you read the last chairman speech of Mr. YC Deveshwar, he actually had a mission of reaching a 1 lakh crore revenue by 2030, and they're all going behind that, by the way. So he was a very inspirational leader, and rightly so. If you look at the spices, so I think somewhere they are now changing the gears, because they now want to grow much faster than what they had grown in the past. And there are clear 2 routes of growing faster. Either you do on your own, buy versus build, as I mentioned to you. Spices is a very unique category. One, you will be surprised to know that spices is a category about 60,000 crore in the country, and only about 30% of it is branded. 70% of it is still unbranded. And all of it is very regional. The largest spice company in the country is Everest, and Everest is about 1,800 crores in revenue. So it's about 10% market share. But Everest, 75% of Everest is actually sold in Western India. So every region has its own brand. Delhi has an MDH, Chennai has a Archie, Bangalore has an MTR, Bombay has an Everest, Calcutta has a Sunrise. So and masala is the hero in the kitchen. So your food becomes tasty because of the masala. It is not because of the staple. So once the masala is there at home, it's very difficult to replace it. So let's say if ITC would have tried to get into Ashirwad masala, which they have already done for the last 5 years, they are still not able to crack the code, because it's very difficult to replace the masala in the kitchen. The household wife or the household lady, it takes a lot of effort to say, okay, aap Everest pav bhaji mat use karo, kuch aur. But today in Bombay, you tell anybody to change Everest pav bhaji to some other masala, you can die, but the guy will not change it. That's the kind of connect that brand has. So what they did, they realized the importance of the brand, and they have a national distribution. Today, Sunrise is only in Eastern India. It's about, if you look at the total size of Sunrise, about 500 crores. The whole market, if you see in India, is about 18,000 crores, and that market is growing at 25%. So about 2,500 crore worth of branded spices is getting into the market. And can ITC take 50% of it? If I was ITC, I will look at what is the incremental growth and how much incremental growth can I take it. Can I take it through Ashirwad? The answer is no. So I do need a brand which is already in household, and can I improve on that? So that is the strategy. So if you look at Sunrise today, which is at 500 crore, in the next 10 years, you take it from me, it will at least be 5x of what it is today, if not more. So that is the kind of growth that ITC can bring. It's again about competency and competence. The guy who owns the Sunrise in Calcutta, and I come from Calcutta, and hence I know the promoters, Sharma's, they are very committed. They're doing this business for the last 50 years, but they don't have the competence to make it national now. Whereas ITC can do it. So the value lies in the eyes of the beholder, as we say. So ITC does see that value, because ITC is saying, boss, if I have to do it myself, I'll probably take 7-8 years, and then I have to invest so much of cash. So if I have to do an NPV, does it make sense? So as I said, DCF is finally the holy grail. And if you do a DCF, they will definitely justify this valuation also. So it's a very classical case where brand, growth, distribution, all the three matrices that I spoke about, all matches here. And it is so surprising that, you know, if you look at ITC, I mean, if you look at the brand architecture, and I'm sure they would have thought about it themselves, they have a Sunfeast biscuits, you know, they do have a Sunbeam coffee, and now they have a Sunrise spices. So it actually fits into their brand architecture also beautifully. So I would say it's a marriage in heaven, if you really ask me. Great acquisition, absolutely. Super.
Amazing, Rakesh ji. Actually, the way that you've put this up, it looks like so passionately that you've been following these things, and they really excite you.
You
I
know,
think this is
it's
something
like
that makes
it's like as I said, it's life is all about, and this is a little philosophical, and I must share with all of you. See, whatever you do, anything in life, one obviously you have to be passionate about it. If you are a finance guy, if you are a chartered accountant, whatever you do, there has to be a lot of passion in it. You should be the best in what you do. Is very, very important. So if I am part of the food world, and obviously I am passionate about it, so whatever who does, because it helps you. See, you have to, when you want to do anything, you have to really enjoy it in a manner where you feel that as if you're doing it yourself. So tomorrow when you get a chance, you do your best. So clearly I think that is applicable to every profession, and more so in our case, because we are in the business of value creation, and we need to get it right every time we do it.
That's amazing insight, actually. Okay, we've got another question, and this is to Raja. What value do you think an auditor adds to the corporate governance? Is it right to make an auditor accountable for management fraud? I mean, offbeat, but maybe we want to take that.
Yeah, I guess I don't want to, comment too much on this because everybody has that question. But I guess we've talked about it, that taking in what Rakesh said, doing your best, right? Definitely, auditor has a huge role in governance, especially specifically on deals. I think Santosh talked about it briefly. Rakesh also talked about it, that when you're looking at a deal, reliability of numbers, I think you definitely look at the quality of the auditor. So what is the quality of the auditor becomes a key role. There have been situations that auditors have been there for whatever reasons. The acquirer is not satisfied with the quality. There has been re-audit, for example. So definitely has a very, very key role in governance. And you talked about last point was a fraud, right? Did you talk about what's the last? I can't hear you, Arpit. Yeah, I can't hear Arpit. Yeah, am I audible?
Is it
I think some issue with that.
Okay.
Make an auditor management fraud?
Yeah.
Is
Sorry,
it right
Arpit.
to make auditor accountable?
Yeah, I won't like to comment on that in this platform. I think there are enough sessions on auditors.
Yeah,
But yeah, you're audible. You're absolutely audible.
Yeah, no problem. Quick. Yeah, sorry. I had to just switch off my camera so that I can save my data. And data is the new oil. So yeah.
Yes.
There's this question on what is the future of NBFC mergers. Anyone would like to take on that?
Rakesh, you want to?
No, Raja, I think you can take that up. I can add.
Yeah, I think NBFC mergers, I think I touched upon it initially, that there is expected to be a lot of stress, right? Because of the stressed assets, the loans getting bad. And as we will go through this pandemic, there's going to be further stress of the NPLs. We've seen a lot of banking mergers happen already. And I guess the NBFC mergers are waiting to happen. Unfortunately, the larger, the good funded NBFCs, in my view, will acquire the smaller ones. But that's the way to go, I would say.
Natasha Matthews asked the question, and maybe Rakesh, you can answer both of these combined. How is it possible to factor in?
we need to take maybe one or two last questions because
Yes,
it's already
that's correct. Yes.
So this
so maybe last one or two questions. Please.
possible to
Yeah. Sorry, I can't hear you.
requirements
Yeah, I can't.
and make future models for valuations in the banking sector.
Can you just
How is it possible to factor in the provisioning requirements and make future models for valuations in the banking sector?
okay.
Am I audible? No?
No, so yeah, you are audible. I mean, see again, these are very subjective questions, and there can't be a perfect answer to this. That how do you? But I guess it will depend on the portfolio of individual banks. I think the banks are already very, I think, conservative in terms of provisioning. They do have got leeway during this pandemic crisis. In fact, there was a Supreme Court ruling today as well, where they have given an extra period for from an NPA provisioning perspective. So it depends, again, if you look at a bank like I would say SDFC, which is largely retail credit, probably their provisioning requirement will be lesser than let's say an SBI, which is largely into corporate lending. So it depends on bank to bank. So there is no honestly perfect answer to this question.
All right then. So I think let's then wind up this today. Thank you very much, all of you. And it's already 8:20 on the clock, but still we have around 250 people still with us. So
It's
that's
dinner
a great.
time.
Yeah.
It's dinner time.
So
Yeah.
thank you, gentlemen,
Thank you.
for staying so late with us, and thank you for creating this beautiful session today, the day one of this refresher course on due diligence, M&A, and private equity. Thank you once again. Thank you, Alokji. Thank you, Santosh. Thank you, Raja. And very, very, very thankful to Rakesh ji for accepting and coming us back and giving his beautiful insights on various things, and also guiding the chartered accountants and freshers how to maybe go about a career in this space as well.
Absolutely. Yeah.
Thank you once again. And before it's wise people say that before they leave, before the audience leaves you, we should leave them. So let's say a good night to all of you. And
Yeah. And
tomorrow we will
congratulations, Arpit, to you as well. Congratulations to
Yes.
you as well to put all this together.
Yeah. Done a great job, I must say.
Absolutely. And
thank
have
you.
a great deal making for all the participants, I guess.
Yes, I really hope that we all get out of this a lot of value. And tomorrow we are talking about due diligence purely, and we'll also discuss on report drafting. We've got people from Deloitte tomorrow, Krishna Chaturvedi and Anil Talreja joining us. So friends, see you all tomorrow again. Thank you once again. Good night. Stay safe.
Good
Thank
night.
you very much.
Good night, guys. Thank you.
everybody.
Bye. Thanks,
Bye.
Raja. Thanks.
Thank you. Thank you.
Mishra ji, please stop the recording and let's upload for future viewing.